Today, this you have the credit module evaluation that should come in, but due to this lecturers, the situation, we have brought up the trade module first before, because this is not connected to the straight credit module. So instead of trade module evaluation, I'll be doing trade today. Okay, so a little change, but you'll be getting this. They'll be doing the next time after I finish my trade. You see that the sequence has changed a bit. It has uh, moved up. I have come up, and whereas today you should have done trade module evaluation. So let us do trade today and finish my trade by next week. And then after that, Menaka told me that he will do they'll arrange for the trade module evaluation due to the unavailability of various factors like the lecturer availability and things like that. So I hope you all will. That message he wanted me to give you all. Is it clear? Are you all clear on that message?
Yes, sir.
Yeah.
Clear, no? Right. So we'll start trade today. Okay. Today, this Sunday and next Sunday, we'll do trade. Now, basically, trade is part of your program, and as you know, trade is a technical subject which is quite yeah, I mean, it's a large subject. But my focus today is to make it to do such a way that in your working environments, right, wherever whichever branch you're working, whatever, where you have customers coming to you to talk about international trade. So most of you may not have a knowledge of international trade enough to talk to a customer and see what he wants. So my focus will be, when I finish today and when I do Sunday, you will have the confidence if you're a branch manager, or you're a branch operation manager, or you're at the counter, we are working the counter, and somebody comes and talks to you about some international trade, right, import export business. With my lecture to you this week and next week, I trust you'll have enough confidence to talk to that customer who comes to you and capture that business. So idea of whatever course we're doing in banking is, or whether it is credit management, or whether it is the Institute of Bankers, or the AIB, or whatever, right, is basically to facilitate our work, day-to-day work, make it easy for us, as well as to maximize your knowledge and get benefit for your organization, right? Whichever bank you're working for. So with that idea, now please bear in mind, today, from the lecture I do today and tomorrow, I want you all to see by next week, when I finish, what is your standard of international trade. Forget about exams, very important, true, I know. But within yourselves, right? Within yourselves, how do you feel? Today, how you would have, if a customer came to you today now and spoke to you international trade, how do you feel? And after I finish my sessions next week, see how do you feel. Whether your confidence level to tackle a import-export customer who comes to you has increased. So that is a focus of my sessions today and tomorrow on next Sunday. Of course, there is exam, you have to pass and do a paper. But it's not only the exam. What is the purpose of just doing and getting qualification if you can't practically use it? So I will try to go as much as possible in a basic manner, right, where you will understand. Where you will understand, all of you all are not in the international trade department. That is why you get in a bank, the branch manager, he has so much of work, okay, but international trade operations, like treasury operations, okay, are different. There are different departments to handle that, right? You don't expect the branch manager to know everything in trade, okay? He has other work to do. So because these are specialized areas, there are specialized departments of this. But however, even though there are specialized departments, when a customer comes to you to talk about international trade, you can't tell him to go to, say, if you're in Kandy, you can't tell him you go to head office in Colombo and talk to the international division. No, you can't. Then you lose the opportunity. So what you must do is, you must be able to have the knowledge to capture that customer and see they talk to him, use your basic knowledge which I'm giving you, and entice him, capture him. Then later on, for more technical understanding of his problem, you can refer to international trade. Okay, so that's how our focus will be. Just give me 1 minute. Rosie, Rosie, close the door, please. Hey, close the door. Right, right. So let us start. Now, as you can see on the first slide, it says, what is trade? You see, international trade, no? First of all, it does say what is trade. Now, when I said trade, all of those of you who are full economists and things like that, don't worry. Don't go to talk about too much of technical terms of trade. What I'm trying to say, what is just trade? Trading is you're buying and selling, right? Buying and selling means you are giving something. Say you're giving a shirt, right? And maybe you might you have about 10 shirts, so you don't have trousers. So what you'll do, you will give a shirt, and another person has about 10 trousers. He doesn't have shirts, so he will take a trouser. So you will trade to do what you want, what you need, what you don't have, you try to get. Basically, that is what is happening in trade, right? Then you'll ask me, what about money? I'll come to that. No, it's not that. In trade, you say, I go to the shop, I don't ask them, I don't give the if I go to the grocery stores, I don't give him sugar for my house, and I don't take flour from him. What I'm trying to say is, trade means basically what you're trying to do is you're trying to get something that you have, give something you have in abundance, and get something that you don't have. That is what you're doing in trading, right? So, example, if you take even your home, take a home, right? Now, if you have, say, in your house in the morning, you ask your housemaid or whatever, what is short? You say sugar is short, right? Now you want to go to the shop. Okay. Now what do you think the shopkeeper will want? And what do you have to give the shopkeeper? So you must give something to the shopkeeper that he wants to know. He will have the sugar, right? You can't go and tell him, I have a chair in my house. Can I give a chair to you? Will you give me a kilo of sugar? No. He will not. You say, no, I don't want to deal with it. I don't want to trade with it. I don't need chair, so I don't have to give sugar. So basically what happens is, there's a thing called what we do normally now, buying and selling. The item that shopkeepers always want is money, right? Now money is a commodity, right? Like anything you hang at home. So you have money at home. You have excess money, but you don't have sugar. So what you do? What is the shopkeeper says? Shopkeeper says, I'm willing to do trade with you, but what I want is money, not your chair or your bed or your table. I can't exchange that. So you have money, so that's the item that he wants. So you give him money and he gives you sugar. Okay. So that means he wanted what his need was money, and what your need was sugar. Basically, that's what happened. He wanted money, you gave him, and he gave you sugar. Right? So this is how. So bottom line is, you're giving something you don't have, that you have in excess, and you're getting something you need. That is what basically trade is. Right? Now, I have covered the second question also. Why do you need to trade? And I told you what is the reason is. You try to give something you don't have and get something you want. Okay. Now, you will ask me about this money. I'll come to that. Okay. Now, what is the difference between domestic trade and international trade? Now, these actually, part of my lecture is basically understanding English words. Okay. It's not that technical. I'll go technical. Actually, my first session, maybe a good part of my session today, right, will be mainly not too technical, okay, but an awareness of trade, international trade, and maybe after tea we may start a little technical, and then after that next week we'll do also will be technical. But technical means don't get worried about it. It's not that so technical that you can't understand. It's very simple. So that the technical knowledge I'm trying to give is for you to be able to, of course, definitely answer the question paper in the exam. But that is not that is in a micro thinking level, right? But in macro level, you think of it. I want it for you to have the knowledge to facilitate your day-to-day work and get better opportunities. Okay. Now, domestic trade means, right? You know, domestic, no? The word domestic in English, what is domestic? Domestic means home, right? Some people say, do you have some people say, have you got a housemaid? to a house working. Or somebody might ask, have you got a domestic aid? Domestic aid means person helping you in your house. So when trade is done in your house, right? That is domestic. Basically, here when you talk about domestic, you call domestic as your country, within your country, within Sri Lanka, right? Whatever trade we do within Sri Lanka is domestic trade, right? And when you talk of, say, Sri Lanka doing business with another country, say India, right? Then it is known as international trade. Now, the international also, right, is nothing technical about it. You see, you break this word. Inter means between, right? National means two nations. National means nation. So, trade between nations is called international trade. So it's very simple, right? Now, okay, now let me go to regarding this money, right? I told you. Now, international trade is between countries, right? Is that clear? Okay. Now, let us see. For example, we'll say Sri Lanka wants to buy some oil from Saudi Arabia. Okay. Now, Sri Lanka goes to Saudi Arabia and tells them, look here, my friend, I want some oil. Right? Then Saudi Arabia says, yes, I'll give you oil. What have you got to give me? So Sri Lanka will say, okay, we have tea. We have tea to give you. But Saudi Arabia says, you see, my friend, tea is something that we are getting from other countries. Right? So we don't need tea. Right? Then Sri Lanka is asking, okay, if you don't want tea, then what do you want? Then that person says, can you give us a commodity? Do you have a thing called dollars? Huh? I'll take one currency. Yeah. What is that? Do you have dollars, US dollars? Do you have? That is what we need at the moment. Then Sri Lanka says, dollars. So you won't take my tea? No, we don't want tea. You have tea, rubber, coconut, these garments, you have gems. Plus, do you have dollars also? Give me the dollars. Then I give. Otherwise, we don't get tea. We get from Kenya, we get from India, we get everywhere. So we don't need tea. So now Saudi Arabia is asking for dollars, right? That commodity. Okay. Now we ask Saudi Arabia, why do you want dollars? Why are you asking dollars? Why don't you do tea? Tea we have. So what can you do with dollars? So then Saudi Arabia, the thing is, this means I wanted to buy some cars from Japan, right? I want to buy some Toyota cars from Japan. So I told Japan, the Saudi Arabian guy telling, right? I will give you oil. Can you give me some cars? The Japanese oil guy said, no. I get enough oil from other Middle East countries. When America I get, right? South America, right? Countries. I don't need your oil. Then the Saudi guy asked the Japanese guy, what is that you need? Then the Japanese guy says, I want dollars. That commodity dollars do you have? I see. You need dollars. So the Saudi guy is explaining to the Sri Lankan guy, now see, when I want to buy a car, the Japanese guy is asking commodity called dollars. We say US dollars, right? Now, if you tell the Sri Lankan guy, instead of tea, if you give me dollars, then I give you the oil and I take these dollars and give it to the Japanese guy. That is what he's asking. Then the Japanese guy will give me cars. Right. The Saudi guy is asking the Japanese guy, why man, you don't need oil. Why are you asking dollars? So the Japanese guy says, it's like this domain. My young generation, they want to buy some, they want to get some dolls from Hong Kong. Like Japanese dolls, they want to get some made dolls from Hong Kong. So Japanese guy is telling the Saudi guy, when I went and told the Hong Kong guy, I can give you some cars, can you give me some dolls? The Japanese guy, the Hong Kong guy says, no, I don't want cars. Can you give me dollars? So, Japanese guy told Saudi guy, look here, my friend, when I give you cars, and if you give me dollars, then I can take those dollars and go and give it to this Hong Kong supply of dolls. Please ask me that. That is why I'm asking you dollars. You see, I'm not going to monetary theory, all the theories. Basically, what happens was in international trade, right? There is a common commodity which everybody likes to have, to deal in, right? So that commodity will say for one currency is US dollars. So that is why Sri Lanka needs to have as a commodity dollars, right? Because otherwise, what will happen is they can't buy the oil. The oil fellow can't buy cars from Japan. The Japanese guy can't buy dollars from Hong Kong. So Hong Kong guy then so goes on and on, right? So to do international trade, the common commodity, I'll take one currency means foreign currency. Just take dollars for example. Two example is dollars. So Sri Lanka has to have dollars to get that. Now what does Sri Lanka do? Sri Lanka says, oh, this is a big problem now. These people are only wanting dollars from us, no? Now how do I buy the oil from Saudi Arabia without dollars? So there's a guy from, we'll say, Dubai, for example. He wants some tea. So he will ask the Sri Lankan guy, can you give me some tea? I can give you, say, he also has some manufacturer will say, some product from Dubai, or even you say even some petroleum product, right? I can give you. Then Sri Lanka says, no, we have enough the petroleum products. We are getting oil from Saudi. We have got petroleum other products we have. We don't need. Then Dubai guy will ask Sri Lankan, what do you want? He'll say, Sri Lanka will say, I need dollars. So why do you need dollars? No, man, if these dollars if I take, I can buy the oil from Saudi guy can buy the car from Japan guy can buy dollars from Hong Kong. So therefore, I will give you the tea, but you have to give me dollars. You see? Now to get the picture is, if you want to get something from another country, right, and the preferred commodity, the deal is, we'll say, I'm taking one currency, right, dollars, then Sri Lanka has to have sufficient dollars to pay those guys the money. Like Saudi might want dollars if you are buying oil, Japan might want dollars if you are buying a car, Hong Kong might want dollars if you want to buy dolls. So Sri Lanka has to have dollars, right? So if Sri Lanka has dollars only, we can buy those things. Okay. Similarly, what Sri Lanka will do is, when Sri Lanka is selling, because of this need for dollars, when Sri Lanka is selling, they will sell anything, tea, rubber, coconut, garments, gems, rubber products, handicrafts, spices, all that when we sell to overseas countries, we will tell them, you give us dollars. So with the dollar, everybody wants, if you have that, we can go and buy anything from any part of the world. If everybody wants this commodity. Now do you see? So Sri Lanka has to have dollars to buy anything they need, what Sri Lanka needs, right? But what if another country wants to buy something from us, not our commodities, we tell them, okay, we deal in dollars. Right? So this is how international trade takes place. Very basic, okay? So I hope that's understood. Because now, as you know, the current situation, what is happening in the country at the moment, all are talking about dollars, dollars, dollars. We are going to, we don't have dollars. That this, that. Can you see? This is what is being talked around. The thing, Sri Lanka wants to buy now. Sri Lanka has debts to pay. We need the dollars. They want the dollars. So how will we do this? Understand? Now do you understand? Every day the papers, people are saying, one opposition is saying there are no dollars. The government is saying they can get the dollars. So this is how it goes. So now I'll go to the next slide. Okay. Now this is actually, now don't try to adopt all these and see industrial exports 9 million, agriculture exports 2 million, $2 billion, and exports total 11 million. It doesn't have. I have only put the basic ones, right? There are small items that I have not included. So it won't tally, but I just given highlights of the main products that we export. Okay, this is on the export side. Okay, now what do you mean by exports? Right? So yeah, now before I come to this exports word, what is exports? The word export itself, right? And again is English, right? Export means what? Now when you go to a theater, right? You sit and look around, you get a lot of doors. You get a lot of doors. I don't know if now it's modernized. When I'm talking about my time, I've not gone to the theater for a long time. Okay, so on the door, when you sit in the theater inside, on the door you can see a board, exit. That means what? Exit means going out, right? So exports means these are commodities that are going out from the country. We are sending export, going out of our port. That is what we call export, right? Then the other word is import, right? Or here to say on the other side, say in, right? Going in, right? So when you say import, that means it is coming into the port. Okay. Now I know I have caused you confusion, right? What is the confusion? Confusion is I am saying export is going X out of the exit. Okay. Then if things are coming into the port, how can that word be import, IMPORT, whereas it should be INPORT? If you're saying X going out is exports, then coming in should be imports. Right? Then you'll ask why the English is having imports. Actually, really the truth, I have not done research enough. And not that I did not do, I did. And maybe now I'm lecturing for the last, since I came to Sri Lanka from by working overseas, maybe 15 years, right? I think I have not been able to give a correct answer to that. I have only one answer to give you, right? Why it is IMPORTS instead of INPORTS, right? The explanation is nothing in any books anyway, not a textbook explanation. I just looked at the keyboard, right? Same as a typewriter those days, right? I find N and M are next to each other, right? So most probably, when originally they tried to type imports, they have accidentally pressed the key M, right? So it became imports. So instead of imports, that is why it's known as, instead of saying imports, it became imports, right? But don't worry about that. That doesn't affect the business, no, right? So you just take it as imports and understand up to that. Now, I don't think that will impact a customer. No. You won't come and ask you what import and imports is, no, right? So just for understanding, right? So the words you can understand, exports, out of very much like if the word was imports instead of imports, right? But so I give an explanation as to what could have been the reason. Right. Now this slide that you see, okay, is about the exports that we have done. No need to compare and see the difference in value and all that. That's not required. Now it was in this year with this pandemic, all this is drastically changed. It doesn't go. This is not the trend, right? So let's forget about the differences. All that is not required. But although I given it for information, only look at the column of December 2020. Let us not even do comparison 19. But since it's knowledgeable for you, I just put that knowledge for you to know. In 2020. Generally, central bank has categorized the exports into various headings, right? For example, like industrial exports, agricultural exports, mineral exports, and unclassified exports, right? Now, industrial exports, take textile garments, rubber products, gem machinery. You can see there, all the industrial exports is $7 billion. 7 billion, 7 billion. 7,101 million. What are those? Textiles, garments, rubber products. No need to know the figures, but have an idea. Okay. Then we talk about agricultural exports. Agricultural exports, you have got 2,300, that is $2.3 billion. Right. And mineral exports, $25, unclassified, all blah blah. Total comes to $10,077 million. Now, what does this mean? What does this mean? Does this mean that this amount of dollars went out of the country or came into the country? Did we? No, if you all are in a class, which I really miss quite a lot, right? I can see the faces. If I ask them, now is this money coming into the country or money going out of the country? I know some are very confident, some are wondering whether money came in or went out. Some because think maybe either. Is it that way? No. What does it mean? I said exports, no, right? So this is the money, this is the amount of dollars that we earned by sending our goods out, selling our goods to other countries. $10 billion, right? Now, what was this? Will this be sufficient to? Why do you need these dollars? Remember, right? As much as we are exporting these commodities, okay, we need to know whether we are able to pay for the item that we are trying to bring in. They are going out. Right. Now, before I go to my next slide, I'll get a small break, right? Which I think I should have done at start, but it doesn't matter. Now, today you are following this session of mine, right? When you are coming here on a Sunday, right? It's a big sacrifice. In this pandemic situation, all that you have to get up at home, and you all are where you could have stepped on, you have to get up and switch on your laptops, right? And home people are there. You've got so many things to it. Maybe pandemic, maybe lockdown, there are so many things in the house to be done. So it's definitely a sacrifice. On a Sunday, following a class is a sacrifice. I also follow classes, and I got no doubt nobody can say it's not a sacrifice. It's definitely a sacrifice, right? Following a class on a Sunday is a real definitely sacrifice. Okay. No, you sacrifice something to get some benefit, no? Right? So, when you are doing that, you will be interested to sacrifice. It will draw you into sacrifice only if you know that what you are going to sacrifice for. You are sacrificing something in your home, being with your kids or with your parents or whatever. You are sacrificing all that leisure and sitting at the laptop at the moment. To get what? Is it something that I am going to get is worthwhile? Then only you will be interested, right? So it should be substantial, something worthwhile, right? So You should be convinced on that. I've given you part of it. For example, like you're doing international trade. Now, is international trade in Sri Lanka a big volume? Is it a big thing? Is it worth you're wasting your time on studying the subject? Apart from the exam, right? So the subject has to be quite wide or substantial for you to be interested. I can tell you that this international trade business, there's no country that can depend only on its products and then exist. It always depends on another country for something else, right? Okay. Like for example, we can get something, we can make it in their own country, but they can get it cheap from another country, right? You know, in economic study that, no, right? So there's no, one thing you must know, international trade is done by all globally. It's a global activity. So therefore, one thing you will be satisfied, I'm going to study something global, right? Second one is, of course, it may be that. But then second, again, you think whether the person who is going to, whom I'm going to listen for the today 4 hours, next week 4 hours, or whatever, right? Is it worth it? Subject may be interesting, but does that person have knowledge? Which I should have told you earlier at the start to get you interested in this. So, if you ask about me, just to give an idea, I joined commercial bank actually in 1978. After school, I joined as a bank clerk. Right. Then I worked for several banks, and also I did a stint overseas, which is at HSBC, Saudi Arabia. I was there for 11 years. Came back, and joined HNB, and worked at HNB till I retired. When I retired, I was the Assistant General Manager for International Trade as well as Financial Institutions, which is the relationship that you maintain with other banks. We'll come to that later, right? That part I'll come to later. So 78 to I retired in 2015, right? Okay, now 6 years gone. I've been since I came to Sri Lanka. I came back to Sri Lanka in 2004, and 2004 to now I'm doing lecturing here and there for IBSL plus some other place, right? I do lectures also on international trade, and fate or destiny is such that I started my job in 1978 as an import department's clerk, right? And up to retirement and then lecturing also, right? I have done only international trade. I never worked in a branch. I never counted cash, right? Actually, when I go to a branch, when I visit branches, I just think what a big task the branch managers have. Oh my God, they are looking at cashiers, they are looking at cash taken, they are talking to customers, they have pawning, they have personal loans, they are in charge of everything, right? They're in charge of the security guy in the front. They go down to the level of even the staff, right? The staff, they don't have proper tea, then they protest, right? If they don't have sugar, they protest. So administration, God, the branch manager's job is a great job. Even the operation manager. In a branch, I'm saying branch people are one thing I have a lot of respect for them because the umpty number of tasks they have to handle. But my life was such, destiny was such that I only did international trade. So from 1978 to now, I only know international trade. Even now you give me a weight of money and tell me to count, oh my God, I can never count, right? So if you see my experience, maybe 45, 47 years in international trade, then you can think a little. Oh, this guy has about 45 years of experience in international trade. Maybe he's good enough to lecture for us for 8 hours, right? And very important. We have good lecture, knowledgeable lecturer to do that also. So you can think whether this lecturer has knowledge if he has done about 45 years of international trade, right? So therefore, second point, first point, whether the subject is a important subject is global activity. So you might think, oh, global activity is very important. Secondly, the lecturer, he has about 40 years of experience. So, okay, that's also good enough. Okay. Then, even now, still I'm lecturing on this international trade. Right. Then comes the also the ability to impart, right? You might have the knowledge, but that of course is left for you to judge whether the lecturer is, that's very important, is captivative, and whether he's going over your head, right? Where you don't understand anything, or he's going too much low, right? But that because, my friends, you have to understand that in a class, all are not equal, right? Now, some of you might be here in this lecture who are in the international trade division in the bank, right? So for you, it might look very basic, right? But for someone in a branch who has very rarely gets the import-export customer, but he has to do this course because he has to do the exam also, and maybe opportunity might come there, right? Okay, then for him, this may be a little complicated. So I had to try to pitch in at the correct level. So I hope I'm pitching. So that therefore, how the lecturer presents it, pitching at the correct level is also that, because judgment you have to know by experience, by following the lecture. That you can't pre judgment is difficult, right? So one person might tell you he was very good, I liked him, I understood. Whereas he had some knowledge. Other person, you in what he said, I didn't understand anything. So it's, that part I can't convince you on that, right? So okay, now coming back to this, right? So therefore, and you understand internet, just because you might work in Gurgaon branch, right? Or you might work in Vaunia branch, right? Or you might work somewhere in like Matara, right? But you see, international trade, just because the ports are in Colombo and Hambantota, international trade does not take place only in these two areas, right? Goods may come from there, but you see, you get importers, exporters all over. You get in Kandy, you get in Matale, you get in Anuradhapura, importers. You can't. So because your branch is not in Colombo does not mean there are no trade customers. There are trade customers everywhere, all over the country, right? They send their lorries to Colombo, collect from the port, bring their goods. So opportunities can be all over the country. In a branch where you work, you might have opportunities, right? They importing a car, right? So it does not mean it's confined only to Colombo or Ahmedabad, right? Okay, now that is it. Now coming back to the subject, before I told you earlier, now see, this export quantum is $10 billion, right? So if you think of 10 billion and convert it to say 200 rupees, just imagine the volume. So that might give you a thought little, oh, this business seems to be quite a big volume. So maybe it's good to know, right? And also this is a global activity, right? So don't you think we should have a little knowledge of this? Okay. So, yeah, so that part, whether you're sacrificing your time, this 4 hours and next 4 hours is worth it, is left for you to judge. Now let us go to import side. We said $10 billion to $10 billion, right? Convert to rupees and see how much. Then you know how much of rupees, right, you're doing. Then you can compare with your P&L in the branch and see is it close to your P&L in the branch, or is it more than the P&L in the branch, or is it less than the P&L of your branch? What is the business? My branch makes more profit than this. Just think about it, right? Understand? From that you can know the volume or your deposit base, or whatever you can see. Right now, 10 billion exports. Oh, what is this? 10 billion exports. I got my deposit base is much higher than that, right? I think like, and it's not a big business. Or my pawning base is much more than this. So it depends for you to judge, right? But I say the global activity. So generally, global activity, you should, as a banker, you have to have some awareness, right? Now let us go to the next one. What is the next one? Exports is what we earn by exporting our goods. We earn $10 billion. Then we come to next one. Now these imports, right? What has happened to imports? I told you forget all this. Right? Just see They also they categorize like consumer goods, non-food consumer goods, intermediate goods. Don't worry about all this, right? But just see the figure, right? I know you see it has dropped compared to this one, right? Uh, obviously with all the pandemic and things like restriction imposed and all that, $16 billion. 2020, the total imports was 16 billion. Now see, $16 billion plus $10 billion of exports, $16 billion of imports. What does that mean? Imports means we got these items, dairy products, sugar concentrate, spices, personal vehicle, medical, all that blah 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 blah, up to down building materials by giving dollars. Right? We earn dollars 10 billion. We have spent dollars 16 billion. So the big question is, how did you spend more than what you earned? Isn't it? Very hard. But is that a big question? Is it a big problem? That I don't know. Maybe we are all doing it now. Take yourself. Most of us. I'm sorry, not all, but just generally. What happens? We earn a salary, say 50,000 for a month. By about the say your salary day is the 25th of the month. By 20th, you have spent about 55,000 or 60,000. How come? You have say either got from your parents or borrowed from a friend and said, "Padita dinna." We always try to spend more than we earn. Right? Normally, when you ask a friend, "Can you give me 10,000 rupees, man? I'll give you for the salary next week." That guy will say, "Mama, make anni." Very good. He says, "Mama, make anni." He says, "No, right." So always, so most of us, I know my IS was like that only, right? Okay. We try to overspend more than what we earn. See, we all are doing that. The country also has done that, no? Obviously. Countries also earning 10 and 2016. So all of us can do, I can't contribute, right? So now see, we have spent $16 billion on imports. $16 billion, multiply by 200, you can know how much rupees. 320 million rupees, right? I'm not very good in that, so I don't multiply that. Okay, now, so total import-export business of the country will be how much? Approximately 26 billion. In 2020, it has dropped because of the pandemic and no activity. But like 2019, if you take here 19 billion and then that was about 11 billion, I think, right? So that's 30 billion. 30 billion, right? So you see, the import-export business, right, is around 30 billion or 25, 20 or 25, $30 billion. The Sri Lankan import-export business for a year is 30 billion, we say about $30 billion. Now, when you say $30 billion, do you think it's a small amount? It's quite substantial, isn't it? Yeah, it's quite a big amount. So maybe now you're convinced also that we will think about looking at the subject. It looks a bigger subject because so much is involved. Right, friends? Imports means we have spent. We have to pay dollars. Exports means we have earned dollars. So we have to earn dollars to be able to spend dollars. That is why you get presently the restrictions on imports, because we are not earning enough dollars to pay for the imports. That is why they say now recently about 625 items have come in. They have said 100% margin. Now, what is 100% margin? What does it mean? Now, when I do the technical side of it, I'll try to touch that. Okay, I'll try to make you understand that what is the meaning of that. What is this? What is the meaning of this margin? They put a lot of basically all steps taken by the central bank recently is to restrict imports, right? Not the important items, essential items. They are medicines, food, right? Maybe for construction purposes, there may be some material required, some equipment for medical, right? Those are important. But say iPhone 11, iPhone 12, then Samsung, whatever, all 300, 400,000 phones, value phones. Do you think we need that? The same, my housemate has a phone that is 20,000. The same call I am taking, she is taking. The same people she wants to talk, her friends she's talking to her friends. I am talking to my friends, she's talking to me, right? But then, and also what happens, we go and buy a camera thing, we go and buy a mobile thing, good camera quality. I don't know why this happened. If you want to take one, buy a camera, right? Instead of spending money on such a small item like that. So that just done. Now people have TVs. Now I can remember when my time we had a fridge, Cecil fridge, small door, more than anyway. My mother managed and cooked and we put my two brothers, my brother, my father, mother, all servant, all we ate. I don't know nowadays. You have a fridge of 4 doors and a wife says it's not enough. I don't know what is happening. Families are still 4, right? Of course, my family is 5 now. My children are all married. Only my wife and I. Sometimes they for them even 3 doors, 4 doors they buy fridges, right? They go and see the way our mental thinking is, right? How we go, whatever waste, we go and buy fresh fish from the market. Okay, oh fresh, very good. Buy and but bring it, put it in the fridge, and eat it after 2 weeks. What is fresh about it? You're lazy to go, say every other day or once in 3 days, go and buy some fresh fish and come and eat. No. You have 4-door fridge, so you want to put all. You have 3-door fridge. I have only 2. I only have a small fridge. There is a 2-door fridge I have, but still I feel it's too much. So like these items which are not essential, which you are spending so much of money, so much of dollars are going to, the government has now restricted. Restricted in the sense they are trying to control the imports, reduce the imports, right? While encouraging exports. Why? Exports means we earn dollars. So the move, you can't help it, right? You can't help it. So why are we finding it difficult to earn the dollars? Well, let us go to the next slide, right? Now see, when I say deficit in trade account, that means the difference between the import and export. We are short by $5 billion, $5,930 million. We are short. That is what we have overrun on our imports. Okay. Now, how do we compensate those losses? How we compensate is like this. Exports is not the only way to earn foreign exchange. Exports is not the only way to earn foreign exchange. There are other methods. What are the other methods? The other methods are, example, work remittances. What is work remittances? Work remittances are monies that Sri Lankans who work abroad are sending into a country. Basically, that's the work. Okay. Now, if I ask you, who are the workers who are sending this money to Sri Lanka to earn 7.1 billion? I know the answer. It can't be different to the answers that I've got for the last 15 years, right? So that even if you all are, I can't see you all or you are not physically here, even if you all are there, your answer will be the same, right? So I will tell you what answer I have been receiving for the last 15 years, right? The answer that I'm receiving is, because 16 since I came back from Saudi, right? The answer I receive is the core money that comes from work remittances who are the Sri Lankans working abroad? First word they say housemaids. Then they say drivers. Right? Now, my friends, this is a bit disheartening, right? Because these people who work abroad, say housemaid, earns a very, very small amount, maybe $200, $300, that's all, right? So how much can that person contribute, right? Drivers, similar amount, $300, $400, that's all, right? You see? So it is not only them. Now, I said I was in Saudi Arabia now, working for HSBC, right? I worked for 11 years. Now, do you mean to say that I was a driver in the HSBC bank? I was not a driver, no. I was head of trade, right? So like that, my friends, I never get someone saying at the start, this is coming from doctors, engineers, accountants, bankers. No. Always the audience says housemaid, housemaid. Or if they can't tell aloud, you can't hear them. You can see them about housemaid. You say that, right? Understand? Why? No, we have top Sri Lankans working abroad. Brilliant Sri Lankan workers. My God, there is even presidents of companies, then financial controllers, accountants, directors, doctors, engineers, bankers. So all are not surveyors, all are not housemaids. Okay, we have got some top guys working. You as a banker, right? Now I don't think opportunities are that much. Normally a banker, say who is doing, let's say for example, credit manager doing credit officer or credit officer. If you are a good credit officer in a bank, let's say knowledgeable, right? Not Saudis because they are not have the knowledge of the rate taking us, right? If you are a little better knowledge than them, okay, you as a credit officer, even today, you can earn, if you have the opportunity, right, in a bank, average maybe $10,000 a month, right? $10,000 a month. Then how many housemaids there is? Put into 300 and see how much, right? Normal $8,000, $10,000 is an average of a credit officer or something working there. So you see, the remittances come not only from housemaids and drivers, from so many people, right? So I used to feel very bad when people say drivers, they think that I'm a driver, I was a driver at HSBC, right? Now, but see this figure, 7,104 million has come in 2020. This is actually, if you analyze, it is disheartening to say you are very happy. Oh, 6,119 gone up. That means more people have got jobs. Or the people abroad are paying higher salaries. No, it's not that really, friend. So many of my friends, right, also come. This is where, due to this pandemic, people have been terminated. They have lost their jobs, right? And when they come back, they are given their terminal benefits, like their provident fund, like what we have. For every year of service, you get one salary, something like that. So if you have worked for 20 years, when you're coming back, they'll give you your terminal benefits, they'll give you 20 years, 20 months salary, right? In addition to what you're earning. So if you're earning, say, $10,000 a month, right? And you work for 20 years, okay? So when you come back, finally, you're terminated or you resign and come back after 20 years, then they'll pay you 20 into $10,000 with $200,000, right? You'll get $200,000 and that's as a terminal benefit. So now see, this figure has gone up. Mainly, I'm aware that has been a main factor. All the workers who came back and have no jobs, right, who will be looking for jobs in Sri Lanka, have brought their terminal benefits. So that is why this figure looks high. I'm not sure what is the figure going to be in the next 1 or 2 years. If opportunities don't open up in the Middle East anymore, and all economies are down, right, globally, and they have to pick up from scratch and recover, will they spend their dollars on foreign workers? Or will they manage with what they have? Till they are able to be a little, like their pocket purse has some money to throw and get foreign workers. So that is a factor, you see. So this is a bit scary. I'm not sure what will be the figure next year or year after next. Let's hope that the opportunities are now on the reverse. All my friends who went with me, I went in 1993, right? But I came back in 2004 after 11 years. But 90% of my friends did not come back, right? They stayed, but now they're coming. So which means they have worked there for more than 20 years, right? And after 20 they're coming, 20 or 30 years they work, they're coming back. So this is I'm not going to be very happy with this figure, right? We have earned it, okay, but whether this is sustainable, is this terminal benefits, right? Which will not come the next year, you'll not have this, right? So many people are coming back to Sri Lanka, their jobs can't help it, globally can't go down, obviously they also can't afford to have foreign workers, so they will come in. Then earnings, see, tourism, my God, it's a real heartbreaking thing. 3.6 billion to 900%. Now, these are areas through which we earn, addition to exports, we earn dollars, right? This is because really heartbreaking. I don't know when this will open up. You're like between the devil in the deep blue sea, because if you bring tourists, you're scared that the pandemic gets spread. If you don't bring tourists, your economy will go down, no dollars. So where do you strike the margin? Where is the correct place strike your balance? It's a big problem, right? So you see, 957 million only we got as dollars from tourism, whereas 3 billion we got. A big drop, right? Then government. This cost has gone down. That doesn't matter because the government influences all other borrowings and things like that. This, like what we said, that last moment to borrow from friends, like that you start borrowing, right? This one. And this is another way of getting income, that is when foreign companies come and invest in your country and start up businesses, then of course they bring foreign capital and therefore we earn dollars. So these are the other than this shortfall came from lack of exports, okay, but we earn dollars from other revenues like this, right? But you see, worker remittance we cannot depend much. Earnings from tourism, I don't know when we'll come back to good figures. Maybe in 2018 we have about 4 billion, right? So it'll take some time. Inflows is going down, is okay. We should manage our funds. We don't need to borrow. Inflows we can take bonds and borrowings and all that. So that this I don't mind going down. But this one, foreign direct investment, no, for foreigners to come and invest, our policy should be sustainable. They should have, now say, for example, they'll go through the government regulations. What are the regulations in this country? And they put a forecast for the next 10 years. If I go and start up a tire factory, or if I start up a say whatever hardware tool factory in Sri Lanka, right? What will be the forecast? 10 years. How much will I make? What will my cost? Based on all that, they start doing a forecast and they come and settle down in Sri Lanka and start the business. But whereas within 1 month or 2 months, the government changes their policy and says something else. That hinders their total projections, right? No imports, that imports costing high, you have to pay more for imports. How will they do? You have to, now say raw material, you have to import, then you manufacture, then you export, right? So things like that. So if the foreigners feel the policies of the government are unstable, you can't sustain it, you're not sure what will happen, and it will affect their forecast, right? Or if there are a lot of protests and things like people are making fusses or strikes and this hindrance to movement of transport of the goods to ports, or people don't know how the labor force is, whether they are very always like rebellious or whatever. Unless all those factors are satisfactory, it is very unlikely that foreign people will come to invest here. So we have to streamline all that, right? We have to streamline. And if you have good sustainable policy, you say, no, these are policy, you come and invest, we will not change. We are assuring you this will be the way it will be, right? Then they'll be happy, right? Our labor rules are very strict. People have to work, do this. You give them the minimum wage. This is the wage, minimum wage. You follow the instructions. You follow what the labor law says. You'll have no problem. If you ill-treat workers, you are going to have it you will have problems. But if you have to be following the labor regulations, quickly, the workers will also not protest. They'll also be happy, they'll work. So like that, sustainable guaranteed policy they will require. But if they think that things are changing overnight, then got today one thing, next one nothing, then of course they'll be a bit nervous to come and invest because all their forecasts will go for 6, right? Then how to do business? You can't do business like that too. So then the FDIs will drop, right? So my friends, this 5 million shortfall is covered by the additional methods of earning foreign currency. Okay, right. But as you know, worker remittance we are not sure. Tourism we are not sure, right? How long it takes? This government, it all depends on not only governments. You know, borrowing from if the government is able to borrow, right? Even if you're saying the government is borrowing funds, right? That is a plus point because, of course, we are way back. But the fact that the lender is willing to lend to you for 10 years, or 5-year term loan, or 10-year loan term, or 20-year loan, that means he has the confidence in the country, no. Whatever policies that we may have, governments may change, but overall, this any government works on a certain fixed framework, and they are sure about the country, right? That they can get their money back. They know they will invest. Whatever interest rate you may offer, 6%, 8%, there is no point if that lender is not confident of whether the government can repay, then of course they will not lend, right? So anyone trying to lend even, right, is a good thing. In a way, it's a positive thing that they have confidence in the country, right? They have confidence that they can repay. That's also it's a plus point. Then, but anyway, we should always try to reduce. We should not borrow on this much. We should try to see that we can, and I think that's what the government is trying to do. Try to reduce borrowing as much as possible, manage within our own sales, right? And direct investments that depend on the policies. So these are the factors that will contribute to the shortfall. So taking all this into consideration, I feel that we must try to promote our exports much more than what we are doing now. What is this 10 billion? Now I'll show you a slide about of course, slide is sometime back, right? Generally, the import-export business going around in the world, and there's certain commodities that have been selected, right? And just now, maybe this slide is quite old, okay, about maybe 4-5 years ago, but still you can have an idea of what import business is going around in the world. We are doing import-export business about 30 billion, right? That's all we're doing, but we have opportunity to do more, to find some more markets. Do we have a market in the world to look for? Are there people buying? If people are not buying, they no point exporting now. This is how much of trade goes around in the world. Okay. Now this is what we show. You see, this commodity, just some identified commodities. Can you see? 9 trillion, 340 billion, 472 million, 405,000. Right? These were the global trade. So our import-export 21 billion is just lost in this, no? The brighter side of it is maybe we are not getting the full opportunity that is available in the market. The market is for these commodities only, right? Okay, I'm not taking all. 9 trillion, 340 billion, 400 million is the market, and ours is 21 billion, which means we have a chance of getting increasing our share, surely. If the 9 trillion business, why can't we increase a bit? We can double it. And 60 billion dollars, that is also nothing much now. Over 9 trillion. So there is a good potential, and we must always work towards trying to increase this quantum. Right? Then let us go to the next one. What is the next one? No, this is you all are very prominent persons, branch managers or operation managers. You all are bank people. You all go for functions. You all go for funerals, parties, weddings, all that. Not now, maybe, right? But when you go for these things, okay, people talk about these things. These are items that you need to have an understanding. Just basic. Don't have to have much knowledge, right? Free trade agreement. What is this? FTAs. What is free trade agreement? Now we have Indo Sri Lanka, Pakistan, Goku, we are doing. It's like only these two, right? For you to have an idea what this FTA means. Now to go through this, I'll let you go through some basics, right? What it means is, now you know how imports take place. Any idea? Say there is a Singaporean supplier, person who gives good to us, who is selling goods to us, is known as the exporter, right? The person in Sri Lanka who is buying the goods from the export is known as the importer. Imports are done by importers, exports are done by exporters, right? Simple as that. So there is a person in Singapore who is selling some fridges to our importer in Sri Lanka, right? So what will he do normally? He will manufacture the fridges, right? Manufacture the fridge with 10 fridges, you say, and then he will take it in his truck, and then he'll go to the port, right? Let us leave the airport for the moment. There are two ports now, either seaport or airport, right? So I don't have to go into details of that now, right? What does the seaport do? Seaport has ships, airport has planes, right? Please don't mix up and say seaport has planes and airport has ships, right? Okay. Now, when it goes to seaport, he takes the fridges and then he goes to the port, and what he will do is, he will, like at a bus stand, right? You see what is the ship that is going to Colombo, right? I will not go to very details of this place. No point. Just have an idea. So assume there he sees standing at the port in Singapore and waiting with the fridges. Then he sees a ship coming, Colombo with a boat. Okay. Then he puts his hand, stops the ship. Okay. And then he tells the driver of the ship, who is known as the captain, please take these goods and go and give to my buyer or importer in Sri Lanka. Right? And he load it. I will further details later when I go and take things aside. So he load it onto the ship, and the ship will leave Singapore and come to Colombo. Right? I don't know how much we have been to the port, right? So when it comes to Colombo, it'll come. So then we'll say the importer goes to the port. This is not how it happens, right? There are a lot of technical formalities, regulation to be done. But this is just to make you understand what is happening. So the importer goes to the port and tells the captain, you come from Singapore, that will be board is showing Colombo, Singapore, right? This is a ship that has come, right? So then he says, Singapore, there are some goods sent to me by my exporter from Singapore. I have got here 10 fridges. Now he's on the port of the sea, port of Colombo, right? Port of Colombo, the ship is there. It unloads the fridges to the port, right? I don't think I'm going too fast, right? Anyway, now he has unloaded the fridges at the port of Colombo, we'll say. So this importer, he goes to the port, has a lorry, we'll say, right? And he loads the fridges, okay? And he will come inside the port, he'll bring that, try to go to the port. But when he tries to go out of the port, now this is the point. Now all what I told is just not exactly what's happening, but basic. Now here is an important point. Now when he comes to the port and tries to go out of the gate, right? There will be somebody, he may underbear product in there, right? Right? I'm got the fridge die. Here the maker. So maybe a document to show how much the fridge is. Make a fridge $1 die. You say. Then that person will say, fridge $1 dana, then he'll go through his book and say, if this fridge is $1,000, my friend, you bought it from Singapore, $1,000, you have to pay a charge for each fridge. You have to pay 50% of the charge you bought, the price you bought at. So if the fridge costs you $1,000, then you have to pay $500 extra before you take it out of the port. Right? Now, who is the person who is selling in this? Is it the police? No. Is it the people who work in the port? No. It's a person by the name of custom officer. Right? The custom officer will say, you are importing fridges according to the law in my book. If you bring a fridge, whatever the value of the fridge is, you have to pay 50% more. Right? So if it is $1,000, you have to pay a charge of $500. Right? Then only you can take it out of the boat. Now that charge, that customs officer, you all know customs officer, person, white kit, they are clean. They don't do anything. They are very clean, honest people. They are white. That's why they wear white, and they have a blue tie. Right? So very cleanly he says, I'm sorry, sir, your fridge, according to the regulation, is duty payable 50%. So the Sri Lankan has to pay $500 charge, right? So of course you won't have dollars, Sri Lanka will have rupees, no? So they convert it to 200 rupees. So you better pay the maybe 10,000, right? Whatever the price is, right? Pay that, and then he will what? Be allowed to take the fridge out. Now when he comes, take the fridge out, it has cost him $1,000, right? $1,000 means, of course, you don't get a fridge for that price. I don't know what must be a deep freezer, right? It doesn't matter. Don't imagine the fridge, right? So $1,000 means 200,000 rupees, right? Now he had to pay 50% custom duty, no? The charge, you know, custom duty, right? So that will be another 100,000. 50% of $500, 100,000 rupees. So then the fridge just cost him 300,000 rupees without transport cost. Forget all that. So now the fridge just cost him 300,000 rupees. So if he goes to the market, he has to sell that fridge at minimum 300,000 rupees to get the money back. Nobody will buy a fridge for 300 and sell for 100,000, no? Right? So if he wants to get some money, make some money, he has to at least sell that for maybe 300, 1,000 rupees. Make 1,000 rupees profit. Right? So that custom duty is what is collected by customs, and of course that goes as for government revenue, and then for building up the roads, maintaining hospitals, free education, and various good things that we enjoy. The good roads and good highways, flyovers, all the funding is done by these charges. Part of this is this custom duties contribute to this charge, right? So now he has bought the fridge, so there's a custom duty, right? Similarly, when we export something to another country, say to Singapore, now we take India, right? Some places they say free port. You can bring anything without any. No, don't confuse yourself on that. It goes to India, say we send something, right? Yeah, we have made some, maybe we have made some handicraft, right? Or we are sending some spices to India, right? Like pepper or whatever, right? Whatever the item is. So when it goes to India, right? When an Indian importer, now Sri Lanka's exporter, Indian importer tries to take the goods out of the port, maybe the Indian customs says, this item and this handicraft, okay, it is 80% duty you take out. So if your spices or handicraft cost you $1,000, right? Then you have to pay $800 as duty, right? So when he takes out of the port, it has cost him $1,800. 800 is the 80% is the duty. 80% is 800. So when he takes out, it costs him $1,800. So he has to sell for anything more than $1,800. The Sri Lankan guy who imported fridge has to sell for anything more than $1,500. Right? Got that? You got the point? That's very important for this to explain what FTA is, right? So what happened was, India and Sri Lanka, they had a discussion. And they said, look here, shall we come to some understanding? I will put a rule in my country that what the Indian exports from Sri Lanka, okay, what the Indian exports from Sri Lanka, that item, whatever duty may be, right, I'll make it half. For example, if a person imports spices, say from another country, right, from in this country or other country, America, surrounding countries, right? If that same spices is costing ₹1,000, $1,000, and it came from, say, a country other than Sri Lanka, if it came from a country other than Sri Lanka, the duty will be 80. I told you, $800. But if it comes, these same spices come from Sri Lanka, India says, we'll tell. If this spice is imported from Sri Lanka, the duty will be only 40%. They cut it in half. Right. Similarly, India says, we have got Indian fridges also, right? Got Indian fridges, we got Indian fans, whatever, right? We say fan. Indian fans, you say, for example, industrial fans, you say, for example, right? If it's imported from any other country into Sri Lanka, the normal duty is, you say, 50%, right? If you are bringing from Italy, Germany, UK, America, China, wherever you're bringing an industrial fan, if it is $1,000, right, the Sri Lankan has to pay 50% duty. That is $500. But Sri Lanka and India became understanding now. Sri Lanka agrees, since you are saying that, telling India, you are saying you are willing to reduce the spices duty by 50%. We are normally have 80%. From any country, spices to India will be 80%. Because you are doing that, we will tell the Sri Lankans, whoever imports an industrial fan from India, though the normal duty is 50%, if that fan is coming from made in India, manufactured in India, and Indian guy is exporting it, right, we will make it 25%. Okay. This is to facilitate the sale of goods of Indian origin and Sri Lankan origin in within the country, increase the quantity. So if any Sri Lankan imports a fan, right, say from Korea, industrial fan, and it is $1,000, he has to pay $500 duty. So when he brings it out of the port, it is $1,500. But if he imports this industrial fan from India, then he has to pay only $250 with 25% duty. So when he takes if a Sri Lankan imports the industrial from India, he takes out of the port at 1,250. But if the Sri Lankan another Sri Lankan imports from Italy or Korea, he takes out the fan at 1,500. Similarly, on the Indian side, if an Indian imports spices from Sri Lanka, and it's $1,000 is the cost, he takes it out at $1,400. But if another Indian imports from any country other than Sri Lanka, he pays 80% duty and goes at 1,800. Right? So basically what happened was, India and Sri Lanka agreed that between themselves, if import and export between themselves, they will give concessionary rates to their products. Will give concessionary to their products. So example, you say Sri Lankan guy There's one Sri Lankan who bought a industrial fan. Industrial fan from Korea. $1,000 duty 50%. He took it out 1,500. Another Sri Lankan bought a industrial fan from India. $1,000 duty 25%. He paid 250. Now we say both are in the Peta market. Both are in the Peta market. Shops are next to each other. Early morning when customer comes, he comes to the Korean product imported guy. You say, yeah, how much is the fan? He says 1,800. What is done? His cost is 1,000 plus 500 duty, 1,500. He's selling it for 1,800. Right? Then obviously 1,100 just make a big profit, no? So he says 1,100. Then the customer says, are you 1,700 too much? Shall I give you 1,400? No. What are you talking? I bought it for $1,000, paid the duty 500, and it cost me 1,500. You want me to give you 1,400? No. Go away early morning. I'm spoiling my day. Go. Then he goes, that same buyer goes to the next shop. He goes and says, oh, you got industrial fan, yes. Very good fan, hardy fan, all that, blah. Not much different quality between the two, right? Okay. How much is this? He said, this is 1,600. Right? Then he says, no man, I don't have money. All the money I have in my pocket is 1,400. Right? Sorry, mate. Right? It's 1,400. Right? All the money I have is 1,400. That's all I have. Can you give this for me for 1,400? Now this guy who bought this from India will think, cost me $1,000 plus 250 duty, 1,250. Right? So he's asking for 1,400. I'll make a profit of 150. He said, okay. Early morning, can't say no to a business now. I'll give you 1,100. Now you see how the advantage is. The guy you import from India was able to sell his goods. But the guy in Korea could not, the cost of 1,500. So the idea of free trade agreement is to facilitate more trade of their products within their countries. In India, it will be more for Sri Lankan goods will be go more because cost will be less. And in Sri Lanka, Indian goods will go more because the cost will be less. The duty has been reduced. So this is the idea of a agreement. But when you say free trade agreement, eventually, now I said they reduce by 50% now. What they eventually want to do is, eventually they want to ensure that whatever goods that are coming from Sri Lanka from India, into Sri Lanka, irrespective of what the duty rate is for. Normally, when you give a duty rate, it does not depend on the country. It depends on the commodity. Sometimes on the volume, the big one like cars, 2,000 cc, 4,000 cc, whatever, right? It depends on the commodity, not the country. Just because you import something in Germany, the duty rate will not be higher than what you import from UK. That does not matter. It is on the commodity only the duty is charged, right? So therefore, over a period, what India and Sri Lanka will do is that they want whatever a person from Sri Lanka imports from India, whatever the duty prevalent rate may be, there will be no duty. Free. Anything, irrespective of what the duty rate is. If you import from any other country, it is free, right? And if a person from India imports from Sri Lanka, irrespective of the duty rate that is established there, if it is on Sri Lanka, it will be free. So this way or that way, there will be no tariff, no custom duty. So that is the ideal free trade agreement. Okay. But there are certain restrictions, right? For example, India might say, the item A, B, C, D, I cannot agree with you to give you free custom duty because if I do that, we have a local production. There are people, farmers working or carpenters working, and we produce the goods in our country. So if I give free duty, then our industries will close up, right? So for these items, please let us not include this in the free trade agreement. Similarly, Sri Lanka will have certain things they are for their industries. Sri Lanka, DEF items, sorry, we can't include here because we already have our industry here. So if I give duty free to your goods, then our industries will get affected and people lose jobs and all that, right? So there are certain exclusions also, right? They put that, they have a list of all the items they're going to have duty free, and that then they put it in that is known as the negative list. Negative means that is a list where in a free trade agreement the countries are not agreeable to have the free trade agreement implemented. They don't agree. Negative list means that is to protect the national interest of both countries, right? They can see only negative list. Saw that, right? That means they say negative list. No, these India says these are my negative lists. Sri Lanka, these are mine. Don't come and ask. So they agree with that, right? Also, there is another thing, right? Now, for example, when you do this trade, now see, there's a smart Indian guy, okay? He finds that he wants to import an item commodity A from Italy, okay? But the duty is 80%, okay? 80%. So, what he does is, he tells the Italian guy to send the item to Sri Lanka. He has a friend in Sri Lanka. Right? Don't send to India because in India the custom duty is 80%. So what he does is he gets that item sent to Sri Lanka. Right? Now in Sri Lanka, remember this, custom duty in each country can differ depending on their, like I told you, the country situation, all their economy and all that. But he finds that that item in Sri Lanka, if a Sri Lankan imports that item A from any country, the duty is 25%. Right? So what he gets a brain, he does is, he tells the Italian guy, you send this to my friend in Sri Lanka. Right? So Sri Lankan guy will pay 25% duty. And then the Sri Lankan guy will ship this to him under the free trade agreement to India, free of duty. So find what does the Indian do? He gets the item at 25% duty. Why he has to pay the Sri Lankan? He paid 25% when it came to Sri Lanka. So the Indian pays only the Sri Lankan the 25% duty. Whereas when the Sri Lankan sends it to India under the free trade agreement, the Indian gets it free. He has only paid the 25% that the Sri Lankan paid for it when it came from Italy. Or a country, right? That was the item. Now that is not allowed. That is not allowed. It's not that easy, right? What is the idea of this free trade agreement? It is for the production of Sri Lankan produce to be sold more in India, and India produced products to be sold in Sri Lanka. Not to sell other people's goods, no. Not to sell Italian people's goods, no, or Singaporean people's goods, or UK goods, no. That idea is not there. That means if you do that, if you allow this, you are promoting the goods of Italian goods sale. That is no point of free trade agreement. So therefore, when you are trying to do a export, India will check to see, or they'll call for documents of Sri Lanka from the Chamber of Commerce or whatever documentation required to ensure that the item that is coming under free trade agreement from Sri Lanka to India is of Sri Lankan origin, manufactured in Sri Lanka. Understand? You can't do like what I said, bring from Italy to Sri Lanka and then send it to India, free trade. No, you can't. They will check to see all documentation, inspection, what they do, to ensure that the goods that are sent from Sri Lanka to the Indian guy is Sri Lankan origin. Of course, you can have a little, you see the last one, rules of origin, right? Of course, now say example, if you're importing, if you're exporting dolls from Sri Lanka, right? You can put a certain amount. Say the doll is cost is 100 rupees. You're going to sell. Of course, you say I spent 2 rupees to bring the ice for the doll from Hong Kong. I spent another 3 rupees to bring the hair for the doll from Hong Kong. So 5 rupees. Out of total 100 rupees cost of the doll, only 5 rupees is imported item, right? In that doll. So there's a certain margin they allow, right? Like sometimes you may the packing game is not very good. You want to make it more attractive packing, right? So you might use some imported packing for that. So those are all they'll allow, right? But the core product, right? The core, I can't tell the exact percentage, maybe 80%, whatever, has to be Sri Lankan origin. That is how you protect the Sri Lanka. That is how you benefit from this. Otherwise, you allow like that, but Indians said bring from Italy and send it to Sri Lanka, then no point. Then you're promoting Italian products. So this is basically what free trade agreement is. We have Indo Sri Lanka, we have Pakistan, Sri Lanka. Okay. Okay, now if you are in a conversation, if you go to some function, right, and you hear people talking about free trade agreements, right, and you all this while you know what it is, the moment you hear them talking about free trade, you might move away from that crowd, right? Suppose they're talking something I don't know. But now you basically know everything what is free trade. Basically, you know exactly what is free trade. So you are in a conversation, we are managing, you're gone for a wedding, you're gone for a party, you're gone for opening, whatever, right? And if they talk free, yes, free trade, yeah, correct, you can say rules of origin, negative list, all you can use. Just say, my God, this person knows a lot. He knows negative list, he knows about rules of origin, which just did not think about, right? So you can very confidently talk, okay? So this is about what is free trade agreement. They're talking about free trade agreement. This is what is talk about free trade agreement, okay? Now that is covers the free trade agreement. Then, now having said that international trade is global, 9 trillion, all that is there, right? In doing this business, now see example, many person in Sri Lanka, right? He is a buyer. You're going to Kyrgyz, say you're going to Goldmark, or you're going to Love Gas, or whatever supermarket. What is that you're doing? You are going, you're a buyer, you go there, you take a cart, okay, and then you go in, you collect all your goods, right? Then you come, okay, then you give to pay the money counter. The counter person representing the Love Gas is the seller, right? So you pay the cash, you got the goods, you go off, right? Simple trade, right? Simple, you go, put it in the car, you go. That's simple, no? So that domestic trade is simple. But international trade, there are certain risks, okay? Now, as you know, there is the buyer and the seller. Buyer is importer, seller is exporter, right? So, also, unlike the supermarket, the buyer and the seller are not facing each other, no? The seller might be in India, the buyer might be in Sri Lanka. Or the buyer may be in Saudi, the seller may be in Sri Lanka. So, you can't have both of them to face each other. If say you're an Indian, you're buying a sari, right? You want to buy, sorry, you're a Sri Lankan, you want to buy Indian sari. Now, if the person from India has a sari in his hand and you have money in the hand, can you all exchange at the same time like in supermarket? You can't. You don't see him personally, he doesn't see you personally. So there is a time gap between the Indian seller and the Sri Lankan buyer, right? Maybe the Indian guy might get the money first and then send the goods to you, or you might get the goods and the money. So there is a risk that one of you might lose between the buyer and the seller, right? Buyer might take and not give the money, seller might take the money and not give the goods, right? So that type of risk is known as micro risk between the buyer and seller, right? That is a micro risk. Now, there are other risks which you think in a broader sense, right? Called macro risk, overall big. Or the buyer seller risk is minor, micro, right? Just between buyer. Now we talk about macro risk, right? What is the risk that are taking place on a macro level? Okay, that means not micro but other factors, right? We thought of on a broader sense. You get, there are so many risks you can think of, okay, but I just put some items like this. One is country risk, one is industry risk, One is blank risk, one is fraud, okay, and then piracy. Okay. Now, I will not go into much detail of these things. Now, when a person comes to you, international trade, your customer, buyer seller risk, you tell. Understand? But you have to also talk to him about the risk. You can't tell him no. Sir, mama කාගේ කියන බඩු ගන්න එනවා. මොකද්ද කරන්න ඕනේ? යන්න ගන්න කියලා කරතක් ගන්න බඩු ටික දාගන්න ගෙවලා එන්න. That's simple. That is simple. But when he says I'm going to do export or import trade, you have to tell him about the risk also. Right? Now let me see. When you say country risk, sorry, I am duty. Excuse me on this slide, it's a bit here and there. Now, country risk means it depends on the political, economic stability of country. An exporter might send the goods, right? Right? Exporter send the goods to another country. He doesn't know how the political situation is there. He don't know what is whether the government is stable. Are there uprisings, right? Or like what happened in Afghanistan? Suddenly America leaves and goes and put them up. The Taliban face the people. So instability, right? Whether there is any problems in the how the political situation of the country is. That is very important. Then the economy. How is the economy of the country? If I'm an exporter, right? Will the economic situation of the country, my buyer might be very, very honest. He wants to definitely not cheat. But then the economic situation of the country is such that they put certain restrictions. They tie his hands with certain regulations. Is the economy going up? Is going into debt? Can they discharge their liabilities? If I send, say, if I send $500,000 worth of tea, will the economic situation permit him to pay the money to you? Right? That counts around. That is economic, right? Then exchange control means can the exchange control, right? This is basically done by the central bank. You know, exchange, all the foreign currency is known as exchange, foreign exchange. So the department that controls foreign exchange is known as the exchange control department. So how are the regulations of exchange control? For example, if you are exporting tea for $200,000, tea has gone, right? And now the exporter, the buyer on that side wants to pay you. But then exchange control regulation says, no, you can't remit. You can't remit money. They are stopped. We don't have dollars. You can't remit. Even if the buyer wanted to pay, the situation is such, the exchange control says you can't remit the money. Right? Then see what happens. You are at risk. Right? Import-export regulations. Right? Say you have discussed with somebody abroad and you want to manufacture, or say you want to import, you're going to manufacture some shoes, okay? And there's a good person who wants to sell raw materials, okay, to you. And he finds you set up the factory, you set up the manufacturing, everything you set up, expecting raw materials to come from there. But due to some import regulations or export regulations, right? They say, no, you can't export. This raw material, we have very limited, say somebody environmental, that this blah, blah, whatever they say. You can't say they're going to give some tree, some box of tree or something for you to manufacture the shoes. Environmentalists come and say, no, you can't. No, you can't have this here. You can't cut the trees. You can't send this. And then what happens? That person can't export to you because there's a restriction on the export. Okay. Then what happens? Oh God, you have set up the factory, you have bought the machinery to manufacture shoes, expecting the raw material, but from the source of that government is such that the exchange control says, no, you can't send that. Then the export regulation, you have to find out what is the export regulation for that. Import will say, right, you want to import some appliance, right? Say like home appliance, some blend or something. Okay. Okay. You want to import. You want to export. You want to export some handicraft. This handicraft, for example, export side now. I told it, so that side no raw material. Now we'll talk our side. You want to export some handicrafts. Okay. So what happens is you set up a factory, you get the people to work, you manufacture all the handicrafts, and that buyer on that side very much likes to your goods, he wants it. Now you try to export. When the time comes after about 5-6 months, you've done the production, you've done the factory setup, got the bank loans, bought the machinery, got the people, now you've done the production. Now you want to export. But that country doesn't have, says, no, I think handicrafts, it comes, will affect our local industry. Even our people are doing handicrafts, it will affect. So the import export control regulation says, no imports handicrafts. Now there's a buyer who wants to buy. But how can he buy? Because the restriction on import and he can't buy. He can't import, import regulation. So therefore, you have to also see how are the import-export regulations in the country. Is it sustainable? It is okay? Is there any problems? How are they going? Do they change every time? That is there. Other one is storage facilities in the port. That is also very important because there are certain commodities, right? Like say seafood, right? If when a ship goes, like say for example, the ship going to touching Singapore, Malaysia, Hong Kong, all that is going. Now when you send a shipload of items, for example, right? It will unload the items and it won't wait. It will continue on the journey. It will go and deliver goods to Malaysia, it will go to Hong Kong, it will go to Japan, all that, right? So it won't wait. So once it unloads, if it is a commodity that can perish or that should be stored in a refrigerated environment, right? Now, like the Pfizer vaccine, right? You need to have refrigerated containers to accommodate that. Okay. If you don't maintain that temperature, those goods will get spoiled. Okay. So you send your goods to that country, and if those countries don't have the port facilities for these things, right? Okay, suitable facilities, then your goods are going to get spoiled, and your buyer is not going to pay you. So you must ensure, depending on the commodity, find out. Oh, this I think I need temper. Now, if Pfizer is going to export to Sri Lanka, they will ask, do you have? If I send it to you, do you have the refrigerated container? Do you have the way to store this? All that they'll ask, right? At the port. After taking the port, it does not matter, right? By the time you paid, right? But in the ports, you find out depending on the commodity, you have to be. So when a customer comes and tells you something, a bit of a sensitive item, you say, is it okay if they just unload and go in the port? Nothing happened to your goods? No, sir, these are all iron steel. I'm trying to expose some iron steel. So some iron, so these are steel, nothing happened. So exposure doesn't matter. Okay, then no problem, right? Okay. Then so like that. So import-export regulations. Then facilities in port. Now that is all for actually countries, right? When this slide is like this. Anyone have the notes now, right? Then comes the industries. Industries means now you have to be careful to see that you don't. Now, say example, if there's a country we need to buy your products, right? Buy your products, and you say, okay, for the next 5 years, I'm going to buy only from you, right? I'm only going to buy from you. Okay. We'll say some product A. So what you do is you get bank loans, you put your money, then you set up a factory, you set up all the machinery and start manufacturing, right? But what happens is now you're thinking of long-term recovery. Within the next 5 years only you'll recover investment because for 5 years that person is going to buy, right? But supposing that product is maybe vulnerable product, right? For example, not sure, right? If you export 1 year, yes. Second year, the demand has dropped, right? There is no demand because they have gone for alternative product, right? They've gone for alternative product. Then nobody wants to buy your product, right? Then what happens? All your investment is lost. So you must see whether your product what you send is sustainable. You must adjust for any fluctuations. You must take all the precautions. I can't do a business analysis for you, but at least must see what if this demand changes. Not very long. People are changing styles very fast. So how long can I sustain this? He has given order for me for 5 years, but will this sustain? Will somebody change? Now, say example, I'll take a solid example. Nowadays, not my generation, my children's generation. Now, people manufacture specs, okay, right? They would have done a lot of investment and started manufacturing specs. But you'll find that the younger generation, they don't like to wear specs. They think they are looking like nerds, right? So they opt for optical, what do you call this, the lenses, right? Contact lenses. They don't like to wear specs. They say, oh, when they wear specs, we look like real nerds, so we don't want. Now the demand is going away for specs. And everybody wants to wear contact lenses. So, like that, there can be a demand, drop in demand for a product. So, when you are doing exports, also you must be very careful to find out whether how the product will sustain. Similar to also if you import, Sri Lanka also people can change, right? Can change. So therefore, you have to be very careful to understand which is the how the demand for a product is. So that is industry risk. Recession in a particular industry, right? See, for example, recession, whatever government industry, right? We had a very good government industry. We had a good government industry, and we were doing very well. Exports were going, and like Americans, no, how they wear those days they wear clothes like they have particular colors for each season. Summer they have one color, winter they have one color, autumn one color, spring one color. Such a situation that if you don't have wear that, I think this is disturbance. I don't know, right? If you don't have that particular color, say in summer or whatever, right? That particular color you don't wear. Say summer is red and winter is blue. But if you are wearing for summer red and winter also wearing blue, then you are not considered as you are not in person. You are not in society. Because each season they had one particular color, right? Red, blue, then then for autumn yellow, and then spring green. So one American. I think the disturbance right now. Disturbance නේද? කවුද කතා කරන්න හෙනවනේ පුතා. disturb වෙනවනේ. නෑ මට හැවුනේ ඒක alright නෑ අනිත් ස්ටුඩන්ට්ස් disturb වෙන්නේ නැද්ද? නෑ. ඒගොල්ලෝ disturb වෙන්නේ නැද්ද? alright okay. alright. නෑ මම කතා මට හැවුනා background එක සද්දයක් එකයි. Okay. Oh, then now okay. Right, guys. So then what happened was now 4 colors are worn by Americans, right? Red, blue, green for the season. They were very real top class people, society. When the financial crisis came in, right? When the financial crisis came in, what happened? The whole thing. The people started I don't tell you how the finance crisis came up. No, who are the people responsible for that? No, right? We are the ones. You are the bankers only responsible. But let us not talk about that, right? So what happened was, American income they couldn't afford. They couldn't pay up their loans. They went down. Then what happened to the industry? Now they found those in factories, you get a what do you call, for shirts one line, for red shirts another line, blue about 5-6 lines of working, 10 lines of working. Factories are very busy. Now what happened? The finance crisis came up, and then what happened? They couldn't afford to buy clothes. So the American who was wearing a summer shirt red, and who wears a blue shirt for summer, for winter, yellow for autumn, and spring green, you found that he wears the red shirt for summer, and for the next summer he's wearing the same shirt. Which means the demand for the 4 shirts that you're buying has dropped to 1, right? Then what about the garment industry? My God, all the lines are made up, all are not functioning because there is no demand. So this is also called recession of a particular industry. Happen. Okay. Then comes competition and pricing. Like, for example, product might go out of fashion. Definitely, right? Now see, there's so many things go out of fashion. You wear a sunglass, it's going out of fashion, right? You wear a trouser, it goes out of fashion. Different ways. Even take the hair. Now those I can, my grandmother, my mother, I can never imagine them having 2-3 tones in the hair, right? It goes out of fashion. So take for example a product like pharmaceuticals. In my time, when you go to pharmacy and buy a product, they'll say Switzerland, right? And they'll buy it. Then that will be exactly Switzerland. How much is a tube? 900 rupees. No other alternative you can't buy. But then the Switzerland producer was very happy. Oh, anyway, Sri Lanka, I'm selling 900. But then suddenly what happened? When the Indian product came in, you go to the pharmacy, he'll ask you, what is that? You want the ointment? Yeah, we have. Switzerland, 900. Indian, 200. You know, same quality, same strength, same, only brand name is different, all specifically same. Then I wonder, my God, if I instead of buying one tube for 900 rupees, the made in Switzerland or whatever, or UK or whatever, I buy 4 tubes. I keep on rubbing, right? Buy 200 rupees. And I have 500 rupees balance also. So what happens is, you tend to buy the Indian one. So this is the pricing or competition may go out of fashion or competitive pricing. Okay. Then product might go out of fashion. Like I said. Then now this part is increasing in the piracy in waters, right? Not so piracy. What happens is, right? This is because just you understand, or not like no. I told not like car is no. You just put your cart, you put it on you put it in the goods, you pay the counter, come and put your car, you go home. But here, when shipments go, they go by sea, right? So when you go by sea, you get a certain problems. Like for example, there are people called pirates, right? They call pirates or pirates. Somebody say you can use any word because when you write only one word, no, right? Not the sound. So these pirates, what they do is they wait for ships to come, and they go in their own ship and capture that other ship which has goods, right? For example, and you see these guys, they come with like, I know those I read the comics and all that, crossbones, 2 crossbones and a face, skull. Those are pirates. So they come and rob the goods from the ship. All they rob all the goods, right? And then what happens? Finally, the buyer doesn't get the goods. Sometimes they do for purpose of robbing the goods, right? One purpose, they rob the goods, the pirates. Sometimes they take it for ransom. For example, they'll take the ship and say some rebels are there. They'll say this so and so country has captured our rebel leader. We'll release the ship only if they release our leader for ransom purposes, right? They take. So there is this, especially in the South, like Somalia, that side, this piracy is very famous, was famous. But I think with our establishment of the Hambantota port, it has reduced a bit because I think they can come to port, get their refill or whatever, and then take another route. As I heard, right, it has helped. to reduce the piracy, right? So the piracy means another group of gangsters or called robbers. They either rob the goods on the ship or take the whole ship itself and hold it to ransom and tell, okay, our rebel leader in such a country is held, they put in jail. You release him, then we'll release him. So these things happen. These are piracy things. So these are what I told you are all risks that you find in international trade. Right? Finally, you come to this one. Well, do small risks, right? I'll just finish with this. Finally, get the bank risk. Here, all international trade, whether it is remittances or goods or whatever, import export, sending the money or sending the documents, whatever, we can come about documents to you later, right, is handled by banks. Okay. So therefore, it is very important that you deal with the correct bank. If a customer is going to deal with a bank in another country, say Singapore or China or whatever, you would ask him, you are going to deal with your customer, with your buyer or your seller through which bank, right? Because banks can come, during the financial crisis, you remember, whenever you switch on the TV in the morning, one bank has crashed. Understand? So many banks crashed during the financial crisis. Every time in the morning with the TV, a bank has crashed, right? So the point is, you have to be very, very careful with the bank that you're handling with. The exporter with handling the bank in China or importer dealing with the bank in Singapore. You have to find out about the bank, right? Now, US branch managers or people who work in the branch are not, you don't expect them to know about this standing of the bank, right? There is a particular department. Now, this is what I said, I handle this part as well, right? In the bank, there's a section called the banking correspondent department. Some banks called it, right? Some bank called it the financial institutions department, right? That's another. That job of that department is, okay, which I was heading when I left, right, is building up relationship with other banks in other countries and assessing those banks. So if your customer comes to you with a, say, I'm going to deal with this bank in China or something like that, okay, what you can do is you can send that name to that particular department of yours and get a report from that department as to how good this bank is, right? Okay. So that department has they always keep a tab. They talk to those banks, they correspond with them, get their update reports. Also, internationally, there's a thing called you can subscribe to a certain publication, right, which is on the net, right, called the Banker's Almanac. In that Banker's Almanac, that company's job is updating all the banks every time they get information. Updating in that, if you're subscribed and say you want to bank ABC, you go ABC Korea. You want to check, right? If you go and check, that will say who are the directors, what is the shareholding, what are the last 3 years profits, right? What is a small brief of their balance sheet, right? Then how many branches they have, what is their rating in the country, what is their rating in the world. So like that, those information there, but not for you. It's for the FI department only normally subscribes to the almanac. So they will take this study plus all other research they have done and finally give you a report and say whether the bank your customer is going to deal with is good or bad, or whether you should go another bank or not good enough. Understand? You go and do another bank. You should go and do another bank. That's what will happen if you go to the department. So knowing whether bank, export, import, dealing with the bank is good or bad is not your job, but it is a financial institution department or the banking correspondent department, right? So therefore, you can tell the customer, oh, I'll check up with my head office and come back to you whether the bank is good or bad. So very important, because in all international trade, bank is involved. Okay, so the bank, and when I go later, when I talk about LCs and confirmation, all that, you'll know why it is important to know what bank you're dealing with. Okay, so we'll go to that next. Okay, then comes that is what I call, like, the insolvency. They are a sustainable bank or not. Then they have this bank. Now see, if international trade, lot of documents are involved. Okay, so when documents are involved, and if they don't have proper checking standards or whatever, sometimes your customer, when he impose something, he might even get penalized for the port. He may have to pay penalties, or there will be big delays in uh, in uh, in releasing the goods due to the wrong documentation that not the bank has not properly checked, right? So that also, that bank standard should be, these are the faults in banks who are checking standards. Then there are certain banks, the say you are exported something, your buyer has paid the money to the bank, but the bank is not releasing the goods, right? Not releasing the money. He has paid, but the bank gives the money. My personal experience is that I know of a country where payments got delayed, right? But they are not cheated. But I know for some reason or the other, when the buyer pays today, they'll sometimes take even a month to send the money to you. Not that they have stayed without paying, they paid. There are situations where they take a month. Especially banks, I know I have heard is like experience in Bangladesh, right? They don't, I have not heard of the dishonoring, but there's a delay. So whenever customer comes and says, I'm going to export some items to Bangladesh, I always tell them, this bank practice there, maybe the culture or the way the bank operates there is such that when your buyer pays, we don't get the money immediately, right? It takes about a month for the money to come. So better for you, say, if you are thinking that you'll get the money within 3-4 days and you cost it, don't do it, because if you are borrowing money, you won't get the money in 3 days, 3-4 days, like normally you might get. It might take a month. So in doing a costing, you're taking a loan, you will not be able to pay the money for about 1 month now. So put that interest cost out into your costing of the product. When you are dealing with countries like Bangladesh, right? And that's what my personal experience, maybe I change or retire, right? But my experience that if you find that the countries, your trade department know when the payments are getting delayed from the country, right? Then you better tell the customer, better mean you put a little additional amount because you might not get the money immediately, right? So that is what you call the delay in effective payments. And also, when you deal in international trade, right? The whole globe is trading Chinese, Japanese, English, Americans, Australians, right? Well, name it and you are there, right? You have all the Hong Kong, Honkies, and Singaporeans, everybody. So what they had decided is that in the International Chamber of Commerce, right? They have set rules, okay, that they expect it is better to deal with a person, with a country, or with a bank that has subscribed the rule. These rules give you a guideline as to how a item should be interpreted. Now, the Hong Kong person might say something in Hong Kong and say, no, what I meant was this. Then the Sri Lankan might say, no, what I meant was this. Or the Australian might say, no, what I meant was this. So to avoid, because global trade is such a complex thing that is happening all over the world, these ICC rules gives a guideline. Whatever you may say, the interpretation is according to the ICC rules, right? Whether it is import or export, right? So dealing with the bank, I don't know any banks that are not subscribed. Those say China had not subscribed, but now China has subscribed. So ICC rules will facilitate the trade better. Better deal with the bank who says they are adhering to bottom when you send later on I'll explain to you. You will say this whatever you're sending to is subject to ICC rules. That means that bank is subscribed to that rules, and therefore whatever interpretation you are having will only finally be according to the ICC rules. So it's always good to deal with a bank that adheres to ICC rules, right? Finally, in banking, bank risk I come across is the workforce and standards. Very important that the workforce standards are very good in a bank, right? For example, in Sri Lanka, I can tell you the standard of training and workforce is brilliant. That is why when Sri Lankans get jobs in Middle Eastern countries or whatever, like Australia or Canada, whatever countries, and they go and work there, right? Those guys, they are very reluctant to tell them to terminate their services, right? You'll always find guys staying for 10, 12, 15 years unless the Sri Lankan wants to come back, right? They always like to. Sri Lankan, I came back to Sri Lanka in 2004, and I've been doing training, and I see banks, how much effort banks take to train their staff. I think Sri Lanka is one of the top countries that train bank staff very well. So you must see that then only workforce standard is very high, right? And how training they do. So that is very important. Whether those banks are doing training properly, they should be a good bank. Then only if the workforce standard is trained properly, then only they can handle a transaction smoothly. Eventually, you want the buyer and seller to finish the transaction. You don't want delays, you don't want losses. No, bank should facilitate a trade transaction to go through smoothly. Otherwise, no point being a bank. That's it for bank trade. Fraud, of course, you get fraud documents that come to you can be forged. Yeah, the document company can be fraudulent documents. So that is a risk you're taking. You have to be very careful to get avoid see whom you're dealing with. When you get a good report on the person, when you get a good record. If you go to your there's another department also like the FICN department. You can get a bank report on it. You write to another bank, ask about a customer, write to those banks. They'll send a report on the customer, so you can judge whether he can be a fraudulent guy or not. Insurance fraud. People like they for example they'll tell they are sending sugar to you and load sand into the ship, right? And then when it comes halfway, you'll find that same exporter comes to the sea and sinks the ship, makes a hole or something, and all robs. Or what he does, he robs all the sand. He has put the sugar, no, whatever item he can get. For example, at a port he loads sugar, right? Then he comes from here and robs all the sugar and puts some sand and ensures that sinks the ship somehow or the other, and then the ship gets lost. Or he robs the cargo, right? Finally, when he'll put sand and go, the cargo comes to Sri Lanka. It'll be only sand. Or what he'll do is they'll take insurance and give a fraudulent company insurance, which when you go and check out the insurance company there, it's not a listed insurance company. So that's the insurance fraud. Then the last one is scuttling, right? Scuttling is where the exporter, once the goods are coming in the Middle Sea, he knows he has put substandard goods in the ship, and if it goes to the port in Colombo, he's a Colombo importer, he'll know the goods are bad. So what he does is, he goes to the ship and he makes holes in the ship. When he's at mid-sea, he comes like the pirates, he comes and blocks the ship and makes holes in the ship. By making holes in the ship, what will happen? Water will get into the ship. When water gets into the ship will start sinking, right? And the importer won't know what he had. What was he's going to say, I sent you seamen very bad, you claim from insurance, the ship has sunk. But what has he done? He has actually put substandard goods, got the whatever document is required by the shipping company, and then sunk the ship by making holes, and the ship goes down into the sea and nobody knows what has happened. So these are the fraudulent things that can happen: cargo theft, insurance fraud, scuttling, okay, forged documents. These are the frauds. So I have covered to you now the parts of risk in trade. What is trade? Why trade is important? What are the volumes that are done in Sri Lanka and the global over? And how important is global trade? And why we need foreign currency? So I have covered you all that, right? Now we will stop at the moment. For the moment, we'll stop, and then we will start with this after break. Okay. Now we are getting more into the technical side, right? Into real documentation and what is all this. Why I spoke to you in more on macro level, just giving you an idea what global trade is, what are the risks in it, why we need dollars, what is the volumes that you give. So you have got all that idea you got. Now we are going into a little more detail into the technical side of the trade. That we'll do it after break. Oh, it's 10:45. So right, so till 11 o'clock. Now I'm coming to more on the technical side, okay? But don't get excited because they're technical, you don't have to worry so much. But basic things that you need to know. For example, I told you when you do an export, say there's an import in Sri Lanka, he's in Singapore, he's manufacturing, he's putting his goods in the lorry, going to the port, right? And then he ships it, put it on the ship, right? The ship comes to Colombo, okay? Then it is unloaded. Then the importer takes it over and it comes to the takes it and comes to his warehouse or wherever, and then he'll have to make the payment to the whatever to the exporter who sent the goods. That is the scenario. No. Now all that I told you without talking about documents, no. I'm just telling you the sequence, the road, how it goes. Singapore exporter, lorry, Singapore port, ship, Singapore to Colombo ship, in Colombo unload, put in the lorry of the importer, take it to importer's warehouse, and also payment has to be made for this transaction. Right. Now there are documents involved in this to do this, right? You can't talk no like Kagis, you can't tell no here the garden, you can't ask the counter because I told you then buyer seller don't see each other now. Now there are all this communication is done usually in the documents. So I'll tell you what these documents are. A few documents, and you can have even you can have 20 documents, right? You know, when I was in the bank, when I was in commercial bank, I was in export department. Now I'm giving only about 5 or 6 documents. Now when we did exports to Syria, right? We did exports to Syria. You will find that they will ask about 20 documents, right? There are about 20 documents. So it varies. The more the exporter, if the importer is not sure of the exporter, he might want more and more documents to ascertain that he's doing the importer is doing what he wants, right? Or sometimes he may have to call for documents because that is the country regulation. Country says if you are importing something, these 20 documents have to come. So maybe that also. Or otherwise, it is just that if the importer is not sure of the exporter, he might want to make sure that what he's saying is happening or what he wants is happening. Right. Now let us take the first thing. These are the documents. Some. See, I have put in dark, in bold letters, some, not all. So for our study now for the moment, for this session, I think this document I listed is more than enough. Right? Okay. Now, take for example the first one, Pro-Forma Invoice. What is a Pro-Forma Invoice? I'm sure in the class now most of you all, when you say Pro-Forma Invoice, yes, why not? I heard that no. Oh yes, Pro-Forma, you heard, yes, yes. But they have heard of commercial invoice. Now, what is commercial invoice? So you don't know. So now I'm going to tell you what are the two differences. But next time you will be very sure what is happening. Now, when you say Pro-Forma Invoice, what it means is, say there is a Sri Lankan importer who wants to import some dolls, right? You'll be wondering why I'm always saying dolls, right? Because we change it for boring, no? So I'll import some toy cars, okay? Toy cars from a supplier in, we'll say, Hong Kong, okay? Maybe today morning he read in the papers and saw some exporter from Hong Kong has advertised, okay, saying that I'm willing to, I'm export of toys, car toys, and I have toys, please contact me. Yeah, this reminds me of another point, right? Now, when say there's an importer who wants to import car toys, right? How does he find out where he can import from? Just also knowledge for you, right? There are so many sources, right? One source is somebody advertises in the newspaper. I am Mr. Ching from Hong Kong. I make Chinese toys, Hong Kong toys, and now it's China, it's Chinese toys. So therefore, I'm willing to sell. If you want, please contact me. That's one way. Second way he can find out is he can go to the Hong Kong embassy and meet the trade council and speak to him. What are your country? What are the things you'll import, right? Then you get that. Can get information from him. Or there may be some publications which say importers, exporters. Now in Sri Lanka also, if we have exporters, our export development board has a brochure. We'll say who are the exporters, what are they exporting, all that. So you can get a list of that. Like that, if you want to import from Hong Kong, you can go to the embassy, ask the information. They'll give you all the exporters of toys from Hong Kong for you, right? Or maybe you in the same market, right? In the Peta market, you want to do something, you ask you can find from another people, other customers who are in the market who are importing from Hong Kong. When I just want to import some toys, can you tell me what are the toys? Yeah, you say, no, don't import my toys. I'm importing dolls. You don't take it. No, you say I'm going to import castmates. So tell me, give me a contact. So like that they're importing similar people. They can come from the market also you can get, right? These are few sources how to find out from where to import. But this person will say, assume this guy he had seen this import had seen it in the newspapers. Then now he saw the contact number and he will now they're talking the conversation on telephone. Hong Kong is like, what do you want? You say no. What have you got? I got armored cars. I got racing cars. I got remote control toys. I got remote control cars. What do you want? Then he might say, I'm looking for something like this, man. This much like toys and this much about 10 I want to import. For a start, I want to import about 15 dozen of armored cars and 15 dozens of remote control cars and another 15 dozen of this like what do you call it, like bulldozers, like toys, right? You say, oh, is that so, right? So when do you want it? You say, this is actually now we are in September and Christmas is coming. Good time for me to have. I want the toys to come into Sri Lanka by end of November, the latest. I have to put it in the market and then it has to be sold. God willing, all conditions are good in Sri Lanka, globally in this pandemic. So, okay, now I want to sell in December. I want for the Christmas, I want to put market. So, at least by 30th November, latest I should have it. Okay. Now, okay. So, what is your price? What are your prices in Sri Lanka? Right, don't worry. I'll send you what my price is, what is the conditions, all that is it. Now, what the Hong Kong guy does is, he will send him a quotation of what he has asked, right? Saying, okay, armored cars, this is the quantity I can give you, 150 dozens, okay. This is a price of 1 dozen, right? And we'll say bulldozers, this is the price. Then whatever other type of cars, remote control, this is the price. So he will send him a quotation. In that quotation also he will say there are various information in that quotation, right? I can ship it by I'll put it in October ship. So it takes 1 month to come to Sri Lanka. So I will put it in the ship and you can get it by end of November. So end of October, you can get it by November. He says, right. That's good. Then he'll say, now when you this is my bank account is this and this is how to remit the money to my money, so much dollars. Sorry. He'll say, okay, we'll say 50,000, $5,000, another 50,000, $4,000, another 50,000, $2,000. 5 and 4, 9, 9 to 11. $11,000. $11,000 is the total price. Now this document that he sends to the importer in Sri Lanka, right? The document that sends to the importer in Sri Lanka is what you call the Pro-Forma Invoice. Understand? Oh. Right. Is the Pro-Forma Invoice. Any issues? No. Right. Is the Pro-Forma Invoice. Now, so when the exporter sends a quotation to the importer, right, giving what are the prices he's going to sell, what are the conditions, how much it can ship, that is like the offer, no, like a quotation, no, right? Quotation is sending to the importer in Sri Lanka. Okay, that document is known as a Pro-Forma Invoice. Understand? Now, before shipping the goods to the importer, the exporter from Hong Kong is sending this document, Pro-Forma Invoice. Understand properly? I have a standard definition how to understand what Pro-Forma Invoice is. Say you go into a restaurant. and you're seated. What did you tell the guy? Hello, I want to eat some cutlets, Chinese rolls. Can you bring the menu? Right? Can you bring the menu? Right? So he brings the menu to you. When you read the menu, what do you see? You see Chinese rolls, 100 rupees, fish patties, 90 rupees, plain tea, 50 rupees, milk tea, 125 rupees, whatever, like all that. So what is that menu doing? It's giving you the prices of the items that are available for you to eat and drink. Have you eaten and drunk yet? Have you finished eating? No. This is before you eat. Right? Before you eat. Okay. Okay. So like that, the Pro-Forma is like the menu card. Okay. Where he comes and gives you the quotation of prices before you eat. Then of course, before eating, I said no. That means before shipping. This in this case is before shipping. Then once you finish eating, okay, then you'll ask for the bill. You finish eating, right? And you'll get the bill. You're eating 3 Chinese rolls, 4 patties, about 5 cutlets, and about 2 cups of tea. You're drunk. Yeah, that's a very hungry day for you, right? Then that document that brings and tells him what he has to pay, amount he has to pay after he ate. After he ate. That is known as the commercial invoice. Understand? Similarly, in the shipment also, after shipping the goods, he will send the bill to the importer, telling him how much he has to pay. That bill that is sending to the importer, telling him how much he has to pay and where to send the money, where bank account, all that blah blah, is known as the commercial invoice. So, basic to understand is Pro-Forma invoice is like the menu before eating. That means before shipping. Commercial invoice is like the bill that you get in a restaurant after eating. That means the bill you send after shipping. So the difference between Pro-Forma invoice and commercial invoice is this. It's simple, right? Now you all are very clear as to what is a Pro-Forma invoice and as to what is a commercial invoice. You all are very clear about it. No doubt about it. Okay? Okay, now 2 documents I learned. Now we come to the next document. That is the bill of lading. A document issued by the carrier's agent and issued by the contract of carriage of goods, also receipt of cargo, etc. Don't know all these words, right? These are all looks like complicating words, but I'll simply explain to you. Now, the Pro-Forma invoice came, the importer was happy, and he confirmed, send me this goods, man, I'm happy with it, to send it to me. Right. So now the exporter manufactures those items, takes it in his lorry, goes to the port, and waits for the ship going to Colombo. Ship stops there. Then the captain says, yes, what is it? He said, I have a cargo for Sri Lanka. Can you please deliver? The captain says, yes, I can deliver, no problem. And takes over the goods. But taking over the goods is not enough. He must give a receipt for that. No. That he has taken it. So the receipt that he gives, right, is what we call the bill of lading. That receipt says, right, I have accepted these goods, and doesn't stop there. It says, I have accepted the goods and I am in contract with you. I undertake, I am in agreement with you that I will take these goods to Sri Lanka for delivery to Mr. Banda, Chairman Banda and Company in Sri Lanka. Okay. Okay. not only is a receipt, it is also the agreement that he's telling, the undertaking is giving that he will take the goods like a contract, what we call contract of carriage. Contract carriage means simple words in English. Contract to carry the goods to Sri Lanka. Carriage is that. Contract of carriage of goods. Contract to carry the goods to Sri Lanka. Right. It is also receipt for the goods he has accepted. While being a receipt, yes, I accepted. Not only accepted, I also agree that I will take this goods to the contract of carriage. That is 2. Now comes the third part. What is the third part? Now once the goods are shipped and the captain brings the goods to Colombo, okay. Now Banda is waiting at the port here that the ship is coming at 10:30 from Singapore. He is aboard Colombo, Sri Lanka, Singapore, Colombo, Sri Lanka, Colombo, Singapore, and he stops the ship. Wait, you got my goods. Yes. I am told that Mr. Ching from Hong Kong has sent me a baggage of cargo of toys, and I am Banda. Here's my ID card, chairman of the Banda and Company. Give me the goods. The captain will say, you may be Banda according to the ID card. That is okay, fine, I agree, no problem. But how can I give the goods to you? How do I know that I'm supposed to give the goods to you? So what is the proof that Mr. Ching wanted me to give goods to you? You are the Banda. You are the Banda whom I want me to give. Then for that matter, what Mr. Ching does is, okay, once he gives the goods to the captain in the Singapore port, and the captain gives him the document as a bill of lading, right? That bill of lading he will send to Mr. Banda. Okay. Once he sends to Mr. Banda has got it by post and he has it in his hand. When the captain says, how do I know that goods are for you? Banda will show this document. Look here, Mr. Captain, the goods are mine because I have this bill of lading in my hand. Can you see? He has put a name to Mr. Banda and Company chairman, blah, 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 all that, right? So, Mr. Captain, here is my document to prove that it belongs to me. So, that document, bill of lading, is also the document that entitles Banda to take delivery of the goods from the captain of the ship. Right? It entitles Mr. Banda to take delivery of the goods from the captain of the ship. That is the document. So therefore, the bill of lading is also known as a document of title. ID card is not now. If you want the captain to release goods, you must have this document of title. What is it? The bill of lading. So what does Ching do? He, once he gets the document from the captain, he will send it to Mr. Banda in Sri Lanka. Right? And that is the document title that Banda will surrender or give to the captain of the ship and then get the goods to himself. That's clear now? So the bill of lading is a contract of carriage, a receipt of that he has received, a receipt for the goods he has received, as well as a document of title. Correct? That's the third document. Okay. Now remember, this is the sequence of Singapore man, Hong Kong person, manufacturing goods, going to the port, shipping it, ship coming to Colombo. Sorry, man. Sorry, I think I said Colombo, Singapore. Sorry, it was Colombo, Hong Kong, right? Sorry, Hong Kong. I confused you all. Sorry. Right. And then it goes to the port, gives the goods, comes to Colombo, and then importer Banda takes it, goes the whole cycle. You all know now. I repeat it so many times, I'm getting tired of me also. How many times I'm telling this? But I'm telling you because it should be instilled with each sequence. The whole thing works on this circle only. This is the international trade. He is exporting from there, he is receiving from here. So trade is taking place completely. Selling, buying. This cycle goes like this, right? I won't touch on the airport because same thing like coming by airplane, right? So that doesn't make a difference. But I took the ship as a common thing, right? Okay. Now get in a few more documents, right? No, they are not very big documents, right? Certificate of origin. These are certificate of origin will determine, like I told you, the free trade agreement. The certificate of origin will determine from where the goods are originated or manufactured, right? Generally, the certificate of origin is generally issued by the Chamber of Commerce of that particular country, right? So, when the exporter wants, when the importer wants, sometimes the regulation in the port, customs will not release you the goods till you show the certificate of origin. What is the what origin it is, right? Will not port authority or the custom will not, you can't take the goods out of the port. So it may be a mandatory regulatory requirement, right? Because there are certain countries have certain sanctions to certain countries. They say no, certain countries goods cannot be imported. So you have to prove that these goods are not from that particular country only by showing the certificate of origin, right? So certificate of origin is which says where the goods have been manufactured. Now, certificate of inspection, right? Generally, these are for big items. I don't think it's certificate for toys, right? But let us never it doesn't matter. Now, the importer, he says yes. He is sending me the bill of lading. Bill of lading says toys, car toys. But how do I know what the quality is? Maybe one car is broken wheel, one car battery is not working, one car no lights are not working, right? So how do I do? So what he will tell the exporter is in Hong Kong, right? I want you to send me, if you want me to make payment for you, you must send me also a certificate of inspection, right? Now, certificate of inspection by whom? Is it by the exporter? Should the exporter give a certificate of inspection? Obviously not. Why? If he wants a certificate, the importer is asking the certificate of inspection from the exporter, right? Simple domain, he say, I have inspected the goods are of highest quality, top class goods, you can never get in the world anywhere like this. His own goods, no. So what is he taking a certificate of inspection from the exporter himself? Then no point. There is no point, right? He'll definitely you, even if goods are broken and not working, he'll say very good. If so, importer will never ask for a certificate of inspection from the exporter, which is no meaning. But globally, there are inspection companies who have branches, head offices in various countries. Where in Sri Lanka also, there are so many inspection companies who are representing their major head offices, like SGS, right? Then SGS companies, one of the inspection company, Bureau Veritas, and so many. You go to internet, you can find so many inspection companies, right? I'll just tell you two of the names, like SGS, Bureau Veritas. So they have branches in all over the world, including Hong Kong, Sri Lanka, everywhere, right? So what the importer says, I want you to get me a certificate from Bureau Veritas or SGS saying that they have inspected the goods and the goods are found to be for the standard that the importer wants, right? Third part, okay? So what happens is the importer, the exporter will go to SGS and say, my importer from Sri Lanka, he wants an inspection certificate from you. Can you please come and inspect my goods that I'm going to send to him and give me a certificate, right? So the SGS will come to his premises, go check everything, and then give a certificate saying that the goods will be inspected, goods are in good quality, all that, blah, blah, whatever requirement. Specification may be given by the importer to the inspection company and says complying, will give a certificate. That is what is called certificate of inspection. Packing list is giving how the goods have been packed. You know, sometimes teas are packed in cartons into tea bags into boxes or whatever, right? So it's easy for the importer when a packing list is good for him to identify. Now, for example, like you know, in garment industry, you get say like departmental stores like May department stores or JC Penney or whatever that you say, right? There's so many Tomil Fig or whatever, right? These people, they have, if you have gone, maybe you want to stay to see about 11-story building, right? Each store floor will have different time. ladies' dresses, children's dresses, gents items like belts or buckles or shoes, right? Then whatever like that, each flow will have item. So when the exporter use a packing list with the goods, right? Uh, the departmental store, when they are unloading, goods are coming container. In the unloading, they know this packing is this item is shirts. Okay, 11th floor. These skirts, third floor. Easy. When they are packing list, when they take out from the container, they know which one is which. Otherwise, they will keep on checking where is the blouses, where are the ladies. So it gives a packing. And also the regulation, I know there's a regulation that the packing list has to be pasted on the container door for the inspection, custom inspections to inspect the goods. There's a regulation like that also, right? Where you paste the packing list on the container for people for the customs to check. They'll take the packing down, number one, take number 6, number like that, right? So that's a regulation to have the packing list pasted on the door of the container, right? That is the packing list. Then weight list, right? So when they want to know how the tea is packed within 1 kilo packers, and 1 kilo packers have 500 gram into 500 gram packs. In that 500 gram pack, how many tea bags are there? How much weight of a tea gram? A bag, all that. Sometimes weight list is required to give exactly how the weighting is done in that commodity. Then you can ask it. So like this, like I told you, Syrian requirements, there are 20. You can keep on asking documents you want, right? So these are some of the documents that are used in the international trade. Okay, like main document is generally the uh, is generally the uh, is generally a commercial invoice, bill of lading, and in most cases the certificate of origin, right? The regulatory requirement. So we'll concentrate on those 3 documents as the total documents, right? In talking, we go further, we'll talk about these things. So remember, bill of lading, what it is, you all know. Commercial invoice, you all know what it is. Pro-Forma Invoice, I told you the offer, that's so important for you, right? You know it. But and certificate of origin, we just assume that those are the 3 main documents, right? But of course, inspection required. It all depends now. If you're confident of the, say, if you're buying something like from Toyota company, or you're buying something from Benz company, you're not going to ask the inspection certificate, no, right? They're undoubted, so you not. If you're confident of the exporter, of course, you will not ask for a certificate inspection. But if you doubt the exporter, you might, for precaution sake, ask for inspection. That all depends. All are your preferences. But commercial invoice, bill of lading, you really require to do a transaction. If you don't have the commercial invoice, you don't know how much to pay. If you don't have the bill of lading, you don't have title document to get the goods. If you don't have certificate of origin, sometimes you want to be clear with the government regulation says you have to have the certificate of origin. So those 3 you have to have. Others are depending on what you want, and you can go on and on and on, right? Then comes to, now we come to a little more technical side. What is it? This is the 4 methods of payment, right? That means when an exporter and an importer are doing a trade, exporter is giving the goods to the importer. Importer is giving the money to the exporter. How are these done? Okay. Okay. Now, must be careful of this question. Somebody asked a question, what are name 3 methods of payment? I am told by the examiners that some of you misunderstand the question. And what you all say, SWIFT, you all say TT, then you all say MoneyGram, something, whatever. That is modes of payment, right? Methods of payment means what are the methods available for import and export to transact the business. So don't make a mistake. Mode is different, method is different, right? Okay. If I say TT, SWIFT, transfer, or whatever, you say Visa card or whatever you might say, right? So those are modes of payment, right? But these are talking methods of payment. How can the money done? There are 4 methods: cash with order, open account trading, document collection, document credits, right? Okay. So these are the 4 methods. I'm going to give a brief understanding. Now, so far that what I've done to you, right? I'm sure you have at least a certain percentage of confidence to talk to a prospective importer exporter, right? You have something to talk to. වැඩේ කියන්නේ customer කෙනෙක් out importer exporter මිනිහා අල්ලගෙන අතරින් නැත්නම් යන්න තියෙන තමයි your capability should be. Don't leave the fellow to go to the next bank. Catch him by the collar and see that he keeps it. Hold him to such an extent that later on, gradually, you can introduce him to the head office trade department for very, very technical items. But how to capture a trade customer, which is also what we are learning and doing all this on for the benefit, right? Okay. So, that is how this I am trying to tell you. So, now I think tomorrow if a customer comes and says, I want to import this item from Italy. You have no idea? මේ items එක ඉන්දියාවෙන් නැද්ද? ඈ ඉන්දියන් quality හොඳයි නේද? ඕ quality එක වෙනසක් නැහැ ඉතින් මම ඉටලියෙන් කියනවා යා විතර හම්බුනේ කියලා. මම අයියෝ ඉන්දියාවෙන් කරන්නේ. ඉටලි වලින් කරන්නේ. Do it from India. Free trade නේ. goods එක duty අඩුයි නේ. මේ වගේ ideas දෙන්න පුළුවන් නේ. හරිද? Now you have some idea, right? Okay. And risky කොහොමද? Is some country says කොහොමද political risk here? ඒ පැත්තේ exchange contract හොඳද? ඔය බලලා කියන්නේද? Yeah. So you have some, at the moment you have got some, I'm not saying full, right? But some percentage to talk to a customer, the trade customer. Now we come to the methods of payment. Cash is order, open account, documented condition. So I'll go through this, okay? We'll see how far we can go on this one for today. One is called advance payment, prepayment. Please, I can't tell you all about the present situation regarding this is only the technical side of the international trade happening, right? In the present situation, regulations can change. If there is dollars, there can be delays, there are sometimes that you can't send dollars immediately. So all that, not only our country, global situation, everybody has difficulties, right? So temporary measures to overcome this pandemic or overcome the difficult period, the government might adapt, right? Of course, everybody try to. There's no government who like to see the country going down, right? All are trying to do something. All are trying to do something to see how to get over this situation, right? So they might implement certain things to see to how we can tide over this difficult situation. So for that, the rules might change a bit, right? Here and there. So I will not touch on that, but I'll be generally tell you what this is about. In all terms and okay, how it works. Now you might ask, advancement, Sri Lanka can do it, right? Can I go to the bank and get the payment done? I can say can, but then the bank might say not today. Today dollars are limited or something. Don't worry all that. Just get the theoretical side of it only, okay? Now advance payment, prepayment. What does this mean? This means I told you both at two distance. One is in Singapore. One is in Sri Lanka. Or one in Hong Kong. Singapore. Now, who is going to know? Now he wants to buy toys. Does the Singaporean guy send the toys to him, to the Sri Lankan guy? And then the Sri Lankan guy sends the money to him? Or how do they do it? Who is going to do first? So this is this payment method. This is how are the methods available, right? In advance payment, the importer, that is the Sri Lankan importer, he will send the money to the exporter. After the exporter gives the money, he will send the goods to the importer. That is what you call advance payment, right? Just see this. Very simple diagram for you to understand. At the start, any business they sign a sales contract. I'll buy you. He's saying I will sell. He's saying I will buy, and both of them sign a contract. Anything you get a contract, no? Right. So contract you sign. Make contract sign. After that, what happens? Number 2 is the importer, can you see here? Importer. He goes to his bank, say he's importing toys worth $50,000, right? Or $20,000. He imports, he gives here. So what he does, he first goes, importer goes and gives $50,000 to his bank. Of course, I won't go into detail. The Sri Lankan who is here, he's an importer. He won't have dollars in his hand. We don't use dollars in the country, no. So what he will do is, he will go and give 50,000 into 200 rupees, which is equal to $1 to the bank, right? To his bank. Okay. Then what his bank will do is, they will take that money, right? I won't talk about charges, all that no need, right? And send that money to the exporter's bank. And number 3. Okay. After sending to the exporter's bank will send the money, will give the money to the exporter. Right? And after doing that, after giving to the exporter will, is the last, ship the goods. Goods come to him, he got the goods, he got the money. So what happens? Transaction is complete. Okay. But here what happened? The importer paid the money first. Okay. Now we'll say, for example, what can happen? He will send the money $20,000. Or we'll say big amount, $1 million. He sends $1 million. Exporter gets the money. He got the money. Now he has to send the goods. Once he gets the money, he laughs and says, what nonsense. And he takes that money, he migrates to another country. Exporter goes to another country. He migrates. Like $1 million in hand, he migrates. What happens to the importer? What happens to the importer? Importer lost, no. He sends the money. And what? He didn't send the goods. Therefore, the importer lost. Correct? So now this is this to the importer. I mean, what if I agree with the exporter for advance payment, okay, and then if I send the money and the exporter doesn't send me the goods, then where do I stand? Oh, I stand loose. Right? So that is the risk for the importer. Is it only risk for the importer? $1 million. It's not a small amount, right? Importer lost too. Anybody else has lost? No. Exporter has gained. You got free money. You not got given any goods. He's okay. He's fine. Right. But can you remember the start? I said we do exports with greatest difficulty. We are doing exports. Marving. $10 billion. $10 billion selling. Why are we earning money on exports? To pay for our imports. So out of the $10 billion we got, if this one of our importers sends it to his customer, and if he doesn't ship the goods, goods no benefit. Not only has he lost the $1 million, out of our hard-earned dollars of the country also has lost $1 million. Fine. If you give something and get something in value, then සල්ලි දීලා ඒකට හරියන goods ආව නම් you're okay. but මේකේ උන්නේ නෑනේ. එහෙනම් ඩොලර්ස් ටික ගෙවුවා මොකුත් හම්බුන්නේ. he lost $1 million. He lost $1 million in rupees. He gave rupees, no. Importer gave in rupees, ne. So he lost his rupees $1 million. $1 million equivalent in rupees. But what happened to the country? The country lost hard-earned export money of $1 million. Right? So because of that, there is a regulation that the country will allow advance payment exporter කලින් ගෙවලා goods එනකම් බලාපොරොත්තු ඉන්න permission දෙනවා. Okay. You send the money exporter, you wait for the goods. ආවොත්යි නැත්නම් නැහැ. හරිද? That is okay. But they are limited it to $50,000. Only up to $50,000. Advance payment you can do up to $50,000. If it is over $50,000, there is another system where the bank has to give a guarantee to the importer. Right? Now $50,000 වලට ගිහිල්ලා goods ආවේ නැත්නම් he lost $50,000, but the country lost only $50,000. If they didn't have a rule of $50,000, then even if he sends $1 million or $10 million, the country loses $10 million. ඒක නිසා the rule is $50,000 for import. Right. Now you'll ask me, what happens if he wants to import something for $100,000? Maybe a biscuit manufacturing line. Biscuit manufacturing line might have about 10 components. Ne? For example, like gattama piti daan එක, then the sifting the flour and making it fine, then separating the dirt, then going into mixing then the sugar or whatever components mix, then another part that will mix the sugar and the flour and everything, we get dough, then the part that makes the dough correct texture, then another part, right, cuts into biscuit pieces, then maybe another part will show how the two biscuits join and the cream is put in middle and made a cream biscuit, and then finally the bake the oven. It goes oven, and from the oven again it will check whether any roasted ones are there automatically, or the temperature will reject, and the good ones will go to the final product, right? So they all will be a line of a manufacturing line, right? Now, if you tell only $50,000, then he can bring only the part that he can put the flour. Line is $100,000. He say, if $50,000, I can only bring the part to put the flour, and then maybe clean the flour. After that, $50,000 then how to do that? That can't be done. But there is a system. I'll run through that fast, right? If the import is going to be more than $50,000, right? It is allowed. Say $100,000, it is allowed. But if exporter wants the $100,000 beforehand on an advance payment basis, then the exporter has to arrange with his bank, whatever, obviously will be one of his banks, right? Whatever his bank, right? To give a guarantee to the importer. Give a guarantee to the importer, right? That if the importer sends $100,000 and the exporter does not export the goods, okay? If he doesn't export, then the importer can claim from this bank that money that we sent $100,000 and get it back, get it refunded. They'll have to pay it back. They have to guarantee. If the exporter will not export the item for $100,000, then the guarantee that this bank gave, unless this bank gives the importer the guarantee, he will not send the money. Bank will not accept also. Bank will ask if the import comes in is say $100,000, the bank will ask his bank, where is the guarantee? That if the exporter doesn't give money, if the exporter doesn't ship the goods, you can get the money back. Where is the guarantee? So therefore, he will get the guarantee, and with the guarantee, he will go to his bank and send the money. In case the exporter does not ship the goods, the importer will claim under the guarantee, get the money back to the country. Then we won't lose, right? So that is I said. Now here comes a situation. If your customer is going to do this, if your customer is going to do an advance payment of $100,000, then and he says which bank is sending the money, which he is getting a guarantee. He's getting guarantee. Always, what you should do is you should not take a decision. Go to internet, look at about the bank. Bank is top class bank, brilliant bank. Okay, the bank very good. Finally, when he makes a claim, that bank may not be even there, right? Maybe the internet is just a fast. You can't, not authentic, right? So what you do is, you as a branch manager, when you get a customer ask for $100,000 and gives you a guarantee, you send it to your head office FI department, correspondent banking department. I told you, can remember about banks, the department, send it to them and tell them our customer is going to deal with this bank on giving guarantee. Is this bank okay? Is this bank good enough for this amount? Can you recommend this bank? Can my customer go ahead and trust this guarantee? Please, you all don't take the decision. Send it to them. Once they say okay, then you can do the remittance. So send it to the right. That is what I call. So if the bottom line is, if the export is more than $50,000, the exporter has to arrange for a guarantee to be given to the importer, so that in case the exporter does not ship, the importer can claim on the guarantee, right? So that is as far as advance payment is concerned. Yeah, importer pays beforehand and gets the goods after that. Okay, and also regulation $50,000. More than $50,000, you need a guarantee. Okay, that's finished. Now we finished one payment term. Now open account. What is open account? This is the opposite side. Opposite of an advance payment. What is that? Opposite. What does it mean opposite? Opposite means in the advance payment, importer sends the money, then the exporter sends the goods. But in open account, exporter sends the money, sends the goods first. Exporter sends the goods and then waits for the money. Right? So, what will happen now? What is happening? The risk. Open account. Right? What is happening here? Here, the exporter contract sales, I told you. Here, now, that one it was 6, no? Last one, number 5, in that last slide. Here, this becomes number 2. Exporter sends the goods. He ships the goods. Right? Now, understand, he ships the goods means, right? He will ship the goods and remember this, because for the next payment term, this counts a lot. And we'll send the BL commercial invoice which says how much he has to pay and maybe the certificate of origin. After shipping the goods, he'll send it direct to the importer. Now, importer has a BL, importer has an invoice, and importer has a certificate of origin. All three in his hand, right? So, what has he got to do? Once he gets those documents, we'll say this side is the port here, right? He'll go to the Colombo port, hand over the BL to the captain, get the goods, see the commercial invoice, show to the now. Why you need the commercial invoice or the customs is? Customs invoice assesses how much it costs you to import only on the commercial invoice. It say how much has the exporter charge you. Depending on that charge only, depending on that rate only, the custom duty is applied as per the percentage in the tariff book, right? It all depends. So for the customs to charge custom duty, they must know what price he bought. He can't just say I bought for $1,000. No, they want to see how much is the exporter billing him for. What is the exporter's bill? That is commercial invoice. How much is say? Looking at that only, the customs will charge the duty. Now say fridge is 50%, they'll see what is the price that the commercial invoice has put of that 50%. Okay. So that by that the customs is able to ascertain how to charge the custom duty. Then certificate origin to okay, know that the country, whatever origin, all that. Okay. Then now see, in this situation, if he sends the goods and he gets the goods, right? What can happen? He can take the goods and just keep quiet without making the payment, right? So who loses? Exporter loses. He has sent for $100,000 worth of goods and he has not got it. Importer not paid it. Then he loses $100,000. His country has lost $100,000. What has happened to the importer's country? They have got $100,000 goods worth of goods. Exporter has sent. Now he must send $100,000 to the exporter through his bank. He is not doing that. Oh, no, see the country. Country has got $100,000 good and importer is not paying. And then another 100,000 saved for the country also. And we got 100,000. Wow, this is good business. Get the goods from the exporter, don't pay. Then country benefits. Dollars not gone out, goods 100,000 coming. Isn't it? So what do you think the government should do? For importers who can take goods from exporters and stay without paying, they must encourage them. Isn't it? Is that it? I don't think. I don't see you all. I think you all don't agree. How can you do that? You can't take goods from us and stay without paying. Yes, that will not be allowed. I will not go to the mechanism detail, okay, but there is a system where the custom tracks it, right? Because if an importer imports some goods and doesn't pay for it, right, then the country gets blacklisted globally. No country will want to deal with us. Say, for example, if the oil producing countries, due to our action of our importers importing and not paying, right, is known, and if they say no, we don't like Sri Lanka, we will not export petrol oil to Sri Lanka. They are bad, they are not paying. Just imagine what will happen to us. Or if all the pharmaceutical companies who make the medicines or who make all the equipments for like our nebulizers and oxygen cylinders or ICU equipment, all that those people who are making those, if those companies say no, nothing to Sri Lanka, yeah, bad, they don't pay. Or from where we get the food, right? All the food that we import, people to eat, right? They all say no, nothing. What happens to Sri Lanka? We are finished, right? So because of that, government has said, yes, you can do open account, but we are closely I don't want to tell you how they monitor. It will be long, right? It will be long, so I don't think I need to go detail, but it is being monitored. So if an importer imports on an open account basis and does not justify and pay that money due to the exporter, or give a very justified reason the goods are bad or some arrangement is made with the exporter to get some new goods instead of the goods he has got, some explanation that is justified is not given to the authorities, right? Then that importer will be blacklisted and he will not be able to engage in import-export trade at all in Sri Lanka. So open account is given, right? There is no limit, right? Can't give a limit now, we don't know what the exporter is willing to give now, right? But you can't stay without paying, because it will reflect badly on the country. So even if the government has allowed open account, right, it's being monitored. So any importers try to cheat, and innocent exporter will be blacklisted in order to protect the image of our country. My friends, that is all for open account. What are the payment methods we spoke about? We said there is 4. Advance payment is 1. Open account is 1. Document collection is 1. Analysis. So now we have finished 2. So we have another 2, right? Which I know I cannot finish today. We got another half an hour or so to go. We will continue this. I'll start with this, but maybe I'll try to finish collections and then touch on LCs. Next week we'll continue LCs and then do Incoterms and little financing of international trade as well. About how limits are calculated and things like that, right? How limits are calculated, what are the import facilities like import loans. You see at the end of the tutor I have that. That will come next week, right? So now we'll see how far we can go. Now 2 payment methods you already learned, right? Two payment methods, okay, advance payment, open account, right? Now let's go to the third one. Document collection. See, in this one, in advance payment, importer sends the money, exporter might not pay. In open account, exporter sends the goods and the BL and the invoice and the security to the importer, he goes and clears the goods and that's it. He doesn't pay. So now these 2 people have a risk, right? So they tell, what is this? How are we going to deal? I can't trust you, advance payment. Oh my God, I send the money to you, you will not pay, you will not receive the goods. Then the explain, my God, no open account, don't talk. I send the goods to you, you will not pay. Now, how do we do this? How can we overcome this? How will we find another solution? So they came to a solution called the documentary collection basis to see if they can satisfy each other. Now, do you think you'll be surprised why I'm asking the question? Do you think document collection base is a good system? Open account has disadvantage for the exporter, advancement has disadvantage for the importer. Now they both compromise and said we'll do document collection. Now does document collection resolve their problem? Better for both. Is it? I know what you're asking. I know what you're thinking. You say, come on. You just said document collection, you never said anything about it, and you're asking us whether it is good. How do you expect us to answer? I know you're confused, you're wondering, what is this guy asking me? He only said document, he's not telling me anything what it is about, and he's asking me if it is good. Okay, I'll give simple. I told you 4 methods of payment, no. But this is not the exam answer, okay? But just to have some, to break the monotony, I'll tell you something. Now, there are 4 methods of payment. First is not good. No, not good. No. Open account is not good. Then came document collection. Can document collection be a good method? I don't know anything about it, but how do I think about it logically? How to answer this question? You might answer like this. I think document collection is not a good system. You say, it's not a good system. I might ask you, oh, why do you say it's not a good system? Because if it was a good system, you won't have another 4th system called document credits, no? So I think there's something wrong with document collection. There's something wrong with document. There's some catch in that, which is not advantage to them. Then is documented credit good one? Then you might say, logically, without telling anything to us, you're asking that question, yes. Because there is no other payment term below document credits. So I think document credit is the best. Simple answer, isn't it? Any don't answer like that. Okay? By somebody else, is document credit the best system? Yes, it is not the best system because it's a document credit system, right? And is document credit the best system? Yes, it's best because there is no other system listed in the payment terms. No, that's not the answer, right? Okay. But I was just telling you to break the monotony. Now let us go to document collection. In open account, look at here. He signs the contract. Okay. In open account, exporter will ship the goods, shipping the goods, and send the BL, invoice, and the certificate direct to the importer. Can you see that? And he can go and straight away clear the goods and save the paying. Now, document collection is small variation. What they do here is, He will ship the goods to, the goods are going to Sri Lanka, okay, no problem. But the BL and the certificate of origin and the invoice, he will not send to direct to the importer to make him go and clear the goods. He won't do that. Dangerous, no? He's going to not pay. So what he does is, he will send through his bank, the exporter, will send the three documents to the importer's bank. Right, to the importer's bank. Okay. After sending to the importer's bank, they will tell the importer, okay, the coordinator and all that. Some of the theory items are there in the theory, but I'm not going to go details, right? You can just read, just to read only. He'll tell the importer's bank, my dear friend, Mr. Bank Manager, I have shipped some goods. Oh, this bank is, we'll say this bank is right, exporter's bank will write in the importer's bank. My customer has shipped some goods to your Mr. Banda and company, right? And now I am sending you these three documents: bill of lading, certificate of origin, and the commercial invoice for $100,000. Please tell Mr. Banda, or to inform Banda and company, that if they want to go to the port and clear the goods from the port, they will need the BL, certificate of origin, and invoice, which are sent to you now. So if they want those three documents, they have to come and pay you $100,000, and then you give it to him, give it to them. Then take the money from them and send the money to us and give them that. So what happens is, he will ship the goods, right, through his bank. Here, through his bank, he's sending the documents to the importer's bank, and what importer is coming, right? Once he makes the payment, they'll give the documents to him. They'll give the whatever the invoice, what he wants, right? The invoice and DL, and those three are enough for him to go and clear it. He has made the payment. Take the payment and send it like this, exporter's bank, and from the exporter's bank straight to the exporter. He has got his money. He has got the documents. Unlike open account, he can't go and clear and keep quiet. See? So the exporter is secured that he got the money, he got the goods. So that open account risk, advance payment, because import not willing to send the money. That open account risk was covered by the exporter sending the documents direct to the importer's bank and telling them, keep the documents, don't give it to him until he pays the money. Once he pays the money is sent to him, and so therefore that is cleared. Importer, exporter got his money, importer got the documents, he will clear the goods. Okay, that's how the document is done. Now, there's a little additions to this, I'll tell you. Now, when the exporter tells the importer's bank, okay, please tell Banda that he has to pay $100,000 and take the bill of lading, certificate of origin, and invoice to clear the goods, right? That system means, what does it mean? When the importer comes to the bank and sees the documents, he has to make the payment to take it. Correct, no? That is what you call documents against payment, right? DP. Payment at sight. As he cites the documents, when he sees it, he has to pay and take. That is documents against payment, right? That is called documents against payment. Is it clear? That is what is called documents against payment. As he sees the documents, he has to pay and take. Okay. Now, There's another thing called, you have heard of, called DA. Documents against acceptance. Now, what is that? At the start, when the exporter and importer work on DP terms, document against payment, he keeps on coming, comes, sends, he sends it here, gets the money, then goes. After a period of time, when the relationship builds up, right, and the exporter now has built up a good relationship with the importer. Now, importer normally in business practically, even though he comes and pays the money and takes the documents, right, and clears the goods, generally in the market, you can't sell goods on site because the importer has to sell it to the wholesaler. Wholesaler will sell it to the retail businessman, and the retail businessman will sell it to the consumer. Right? That's how it goes now. Right. So generally, the wholesaler will always ask for credit from you. Okay. Yes, sir. I'll take your goods. I have to give retailer. Retailer then have to go and sell to the consumer and take time. So can you give me about 90 days time to pay? Right. Although the importer pays at document is paid under DP at site, most of the time importer has to give credit to the wholesaler. That is usual business cycle. You don't find normally that you give importer doesn't sell goods immediately on cash. The market doesn't happen, right? He only gives on credit. Having said that, now after a period of time, when the relation built up quite well, the importer might approach the exporter and say, look here, Mr. Exporter or Mr. Ching or whatever, I am always working with you on documents against payment and I always paid. But you understand that when I take from you, I have to give on credit for 3 months to my wholesaler. I don't get the money. So this is actually affecting my profits and lot of problems for me. Right? Can you do me, now you understand me, what I am? Right? Can you give me a little time to pay your bill? You send the import to me, okay? You send the import like you're doing. Send the documents also to the bank. Don't you send it to me. Don't send it to me. Right? But tell the bank, don't ask the money for me immediately. But to give me a little time. So the exporter might think, now, shall I give this man about 60 days credit? 90 days asking, I can't give 90 days. Once he's just starting, I cannot beat. Shall I give about 60 days credit? Yeah. Also, now this buyer has established my product in the market, right? He's doing a good distribution and he has got a good network also. Now, if I lose him, I'll lose the whole market in Sri Lanka. All my goods will go for 6. Somebody else might creep in. Now that he established himself and my goods are going, I don't want to disturb my market for my goods, Sri Lanka. So how can I do this? Okay. Exporter will tell the importer, okay, I don't know about 90 days, I'm not interested, I can give 60 days. If he agrees like that, right, then what happens is, documents will come here, right, and the documents will be released to the importer, not against cash. He doesn't have to pay cash. It will say, the exporter tells me to release the goods to you on a 60 days credit basis. After you take the documents, within 60 days, you have to pay us. Then we can take that money and send it to the exporter. But however, you just can't take it like that. There'll be instructions saying, normally when you have this credit transactions where payment is made late, you have a thing called a bill of exchange. I don't go to bill of exchange act and all that. I think you all have covered all that, right? There's a document called a financial document called bill of exchange, right? where the importer will sign and give saying that today is the 12th of September. I promise to pay October 12th. November 12th, I'll make the payment. 60 days from today, I'm taking the documents. And he'll sign that bill of exchange and give to the importer's bank. Once the importer's bank has that document, they will release the BL, invoice, and the origin to the importer. After 60 days, he has to come and make the payment to the importer's bank. The importer's bank is in the money. In some countries, you get this thing called stamp duty involvement, very high. So there the buyer and the seller agrees, right? No need bill of exchange. No, not bill of exchange. You give a letter of undertaking. Instead of the bill of exchange, give a letter of undertaking saying that I am accepting the goods today. 60 days from now, which is November 12th, I will come and make the payment. Right? And he will give a letter of undertaking. Correct? Letter of undertaking. Okay? After that, against the letter of undertaking, the importer's bank will release the documents to the importer. Right? So when you deal that way, what is he doing? He is saying, after accepting the documents, 60 days after, depending on the credit period that the exporter is willing to give, okay? 60 days after accepting the documents, I will make the payment. Who is saying? The importer. Right? Now, that is what we call, it is not, he is not paying against the documents. It means that is, if he is paying, that is documents against payment. Right? If it is against, after accepting, is going to pay at a later date, that is known as DA. Documents against acceptance. So now you know the difference between DP and DA. Right? Clear? Now, the situation is, what happens on the maturity date? November 12th has come. Maybe the importer's bank normally diarizes and send a note to the importer, Mr. Banda, Chairman, Banda and Company, you have a DA bill that is falling due on the 12th of November. Please ensure that you have funds in your account for us to debit your account and send the money to the exporter. Right? They will send that thing to him, that notice to him. November 12th has come. There is no funds in the Banda's account. Banda and Company account, there is no funds. What does the importer's bank do? Does the importer's bank inform the exporter that importer has not paid? Or does the importer's bank make the payment out of their own funds and take data from the importer? Actually, a very important thing that you should remember here is, which will be effective and applicable in the next method payment. If Banda does not pay at the maturity date, okay, if Banda does not pay the maturity date, there is no obligation by the importer's bank, okay, importer's bank to make the payment to the exporter. The payment undertaking to pay is purely between the importer and the exporter. Nothing to do with the importer's bank nor with the exporter's bank. Here in document collection, banks don't get involved in the exposure. So if the importer does not pay, right, then the importer's bank can only inform the exporter money is not paid. Or it can also help the exporter by going and exporter go back and say through his bank, please tell that person he took the goods, no, pressurize him to pay, right? And then when he is asking whether to pay, he's asking to pay, not to pay, can help to pressurize him, right? Well, keep on asking, give the money, give the money, give the money. But after some time, of course, the importer bank will say, look here, I cannot just keep on asking, I'm wasting our time. I want to close the file. Now, at that time, what happens is, eventually, what will happen is, either the regulation, I give 1 year also, that doesn't matter. Eventually, what the importer's bank does is, they close their file, and whatever the letter of undertaking he gave, importer gave, or the bill of exchange that he signed and not paid, will be returned by the importer's bank to the exporter. So that exporter either will have a letter of undertaking or will have an unpaid accepted bill of exchange, which, if it's a bill of exchange, is a financial instrument. He can sue the importer under the bill of exchange ordinance, right? A different course of action, right? In a different course of action, right? So that is where it works. Either he can go and sue him under the bill of exchange ordinance, or on that undertaking he can sue him. That is between these two. Nothing to do with this bank. Unless one thing, right? I'll tell you what the thing is. What that thing is, the exporter tells the importer, right, you want time to pay, no? You want, right, I can give you 60 days time, because otherwise 90 days, I'm not getting stuck with my cash flow. So I can't give 90 days, I need the money, right? But I'll give you 60 days, right? I'll give you 60 days on a condition that, exporter is saying, right, I'll give you 60 days, don't worry, right? But on one condition. Now, this is the exporter is not willing to give 60 days just freely. With the letter undertaking, no, he's not happy with that. This, like to give, can give, but not so much, not so happy. So what he says is, I will give 60 days credit on one condition. That is, your bank, right, must guarantee to me, the bank must guarantee to the exporter, right, that in the event that importer does not pay on the 60th day, the importer's bank will pay. That is, importer's bank is guaranteeing the exporter that you give him credit 60 days, and if he doesn't pay in 60 days, I will pay. Who is saying? The importer's bank, right? Now, in a scenario like that, I said banks are not involved in payment, no, they don't want it. But now here it's a special situation where the importer's bank is giving a guarantee to the exporter and saying, you give one-time company 60 days credit. If he doesn't pay, we will pay. Right? Now, that is what you call avalization. Right? That is what you call avalization. Most people, most banks I know are not aware of this fully. Right? Now, when you say avalization, what it means is, we'll say, you just take the bill of exchange. Now the importer is signing on that and saying, I will pay on the 60th day so much of money to the exporter, Mr. King. When it is avalized, in addition to this undertaking, right, the importer's bank is also putting the endorsement on that bill of exchange saying, if the importer who has given you an undertaking that he will pay, right, 60 days later, does not pay, then we will pay you. Remember what I'm saying? Huh? I hope you get a very important point. Is the importer bank is saying, if the undertaking given, first the importer has to give undertaking. Otherwise, the importer bank is not involved. If the importer undertakes, or on the undertaking given by the importer, given to you by the importer to pay 60 days later, and he does not pay on that date. If he does not pay on that date as per his undertaking, then we will guarantee that we will pay you. Right? Understand? So when a bank guarantees the undertaking given by an importer to pay at a later date, okay? If the importing bank guarantees, right, to pay, right, here, if the importer gives a guarantee, the evaluation means the importer's bank is guaranteeing that if the undertaking given by this bank, by this customer, right, by our importer, by a bank, Banda and company, he does not make the payment, then we will make the payment. That is a guarantee. Then when a thing under an evaluation, the importer's bank becomes responsible for the undertaking because they are given a guarantee. If it is a normal collection under DA, the bank is not involved to pay it money. We are not given undertaking, right? So that is what we call evaluation. Evaluation is the importer's bank or a bank, or it can be another bank even, but which normal doesn't happen. All the importer's bank guarantees, the importer's bank will know about the importer, just normal bank will not guarantee, no, right? Importer's bank guarantees the payment undertaking, guarantees the payment undertaken by the importer to pay if it's not paid by the importer. That is what we call evaluation. Now, in this scenario, what is the risk? He said, all right, you gave, money came, he gives DA, gave, right? What is the risk for the, right? If he undertakes, he doesn't pay, I can go and sue. I can sue, I got the bill of exchange, I can sue. If not evaluation, then I can bank there, right? Bank there. So what is the risk here? This is the main point I want to know. But this risk is what carries forward. That is why the fourth payment is there. So let us go to that part to tell you what is the fault in the documentary collection. What is the disadvantage? Right. Now we'll say exporter signs this order. He buys the raw materials, he sets up the factory, he gets the workers, he manufactures the toys, takes the toys to the Hong Kong port, ships it, and the goods come here, Colombo, and it's DP, document payment, and it comes here, right? Then the importer's bank will inform Banda and company, come and take the goods, come and take, pay $100,000, take it. Now here is the crux of the matter. When the Banda's bank informs Banda that come here, there is a document set for $100,000, Mr. Ching has sent you some toys, then Banda comes to the bank. It is, Mr. Bank Manager, thank you very much for calling me. I gave the order 6 months ago. Yes, I know. But unfortunately, due to various discussions of my board, we have decided to diversify and or change our business to importing cars, importing real cars, big cars, not to anymore deal in toy cars. So, Mr. Manager, I don't want that BL, I don't want that silver origin, I don't want that invoice, and basically I'm telling you I don't need the goods, so I won't pay you. Thank you very much, have a good day, and Banda goes back. Now see what I am an exporter. So he goes back and says, we spoke to Mr. Banda, he says now the company has moved a greater change and they have changed the decision. Now they're dealing because they don't need. Now see what I am an exporter. He spent all the money, right? What he can, he did everything. And he sent the goods. He shipped the goods and sent it to where? Sent it to Colombo. Now the goods have come to Colombo. It's a Colombo port, not a thing, Colombo port. Banda is not paying, right? Banda is not cheated, no. He didn't take, not like open account. He takes the documents, go and clean all the thing. He said, no, I will not do the thing. I don't want the goods, I won't pay. What happens next? Does the exporter get the money? Exporter won't get the money. Why? Banda has refused the goods. Now the goods are not with the thing. It is in Colombo, right? It has come to the port. Now, if it is a port, what will happen? It will incur demurrage. And if it exceeds a certain amount, the goods will be confiscated or auctioned, right? So, the exporter has to do something and get the goods off the port. Now, importer is not interested now, right? So, what he will do is, he will tell the bank, please find another buyer with your bank, with any customer you will have, that he has refused, whether anybody else is interested. So bank will ask from the customer, yeah, there's a consignment toys, man. It has come toys, $100,000. They all want, no, we can't. Then one comes say, $100,000. Ask your exporter, I can pay $50,000. As a help, I'll buy it from him. So he goes, yeah, they're offer $50,000, right? Okay. So seller, what? He can't get the goods back, big cost to come back. The more it is in the port, he has to pay more charges incurred. And he's running the risk of auction. And also, if it is very nice toys, there can be pilferage also, right? Okay. We can't say all that. So he'll agree. Okay, give that what to do. We have to give $50,000 now. See, he loses. Right? Sometimes what happens in cases like this, in a case like this, what happens is the exporter, in back of his mind, say 1%, thinks maybe the importer will not accept the goods when I send it. Right? So when he sends the letter to his bank, exporter's bank, to the importing bank, say, please tell Banda to pay $100,000. Okay, pay $100,000. In case he refuses to pay, in case he says I don't want the goods and does not want to pay, then we have an agent in Sri Lanka. Right? Please contact him. Right? And tell him that one of our consignments are stuck in Colombo because the import has not taken, and tell him that to find a buyer for this goods, right? This is the agent, right? But however, now we'll say you should find a buyer, right? So we'll say there's an agent in Sri Lanka, Fernando and Company. So the bank will inform Fernando Company, here Mr. Ching has sent the goods. Mr. Banda and Company has not refused to take the goods. Now the goods are here, right? And they are told in the letter that if Banda does not take the goods, to inform you, Mr. Fernando. So we inform Mr. Fernando. All right. So Mr. Fernando comes. Now Mr. Fernando comes and says, yes. $100,000. I have a buyer. $10,000. Can you get? Now importer's bank will think Fernando is asking $10,000. Shall I get? No. When the exporter gives instructions like that, inform Fernando and company, they must also in that instruction tell what are the things that Fernando is permitted to do. Either they must say, doesn't matter, release the goods to Fernando free of payment or whatever, or they must tell Fernando, tell Fernando that to find another buyer, but don't give a discount more than 25%. Or whatever what Fernando has powers to do also should be incorporated when you are telling the importers bank what Fernando, when you tell inform Fernando, you must also say what Fernando is supposed to do. As you will see in this slide, right? Wait, I'll show you. Here, Article 25, case of need. Okay. In this one, if the principal nominee is representative, if the principal nominates a representative, principal exporter, right? Nominates a representative to act as a case of need in the event of non-payment and non-acceptance, the collection instruction should clearly and fully indicate powers of such case of need. Clearly indicate. In the absence of such indication, banks will not accept any instructions from the given. Case of need cannot say anything. Only they'll follow what the importer said. You understand? So this is what you call case of need. So you can sometimes what exporters do is when they have some little doubt, like little doubt about the payment, they mention their case of need also in the letter, right? So now can you see here in this situation, the exporter is not sure of his goods, right? If the DP document is payment, if the importer pays well and good, right, he'll get the money. But an importer refuses the goods, then exporter will not get his money. So that is the risk in this, right? That is the risk in this. So you might go on to say, right, if that is the risk, why doesn't it do it on an evaluation basis? Give credit to the importer and get a bank guarantee. Okay, this is my last point, right? So we'll say 60 days DA. Thinking that importer will take site, he can't pay, no. So he's giving 60 days the evaluation. On evaluation, no, you think here seller will ask the bank. Sometimes at start the seller will ask the importer's bank, I want to give my Bund & Company evaluation terms, credit terms, but on an evaluation basis. Will you evaluate a DA bill I sent to the Bund & Company? So the bank might go back and say, yes, we will. What is the amount? They will say, up to say, about 4-5 bills, up to $500,000 if I send evaluation bills, will you accept? The bank will say, yes, evaluation bills will do that. Right? We agree to evaluate. No problem. You send any amount of evaluation bills, we will, up to 500,000, we will guarantee. So now the evaluation bill comes. Now on that understanding that the importer's bank will evaluate, get this very clear, the very important point for you for the next one. On the understanding that the issuing bank will, importer's bank will evaluate, he manufactures goods. He set up a factory. He buys the raw material. And for about now 5 shippers, I said no. So once and for all, be a big factory. He manufactures continuously doing it. Now the bill comes here. 60 days. It has come here. It is on evaluation. Listen carefully. It is on evaluation. Right? See what happens. DA 60 days evaluated. Importer comes to the bank. Or he won't even come to the bank. The importer may inform him. We have got a bill 60 days DA, but to be evaluated. We are willing to evaluate. Please come and accept the documents. We are willing to evaluate. Bank has said, no, I already told the exporter. No. But now Banda says, Mr. Bank Manager, thank you very much for agreeing to evaluate. But the problem is, I don't want the goods. Right? Now, if he doesn't want the goods, will he come to the bank and sign a bill of exchange to accept payment in November 12th? He doesn't want the goods. So will he come to the bank and sign the bill of exchange to accept the goods? Will he come and sign out? Will he accept the documents and sign? If he doesn't want the goods, why should he take the bill of lading? And he doesn't need it now. He doesn't want the goods, so he won't take it. If he is not taking the bill of lading and invoice and the security, then why should he give an undertaking to pay? So he won't give an undertaking to pay. So he will not sign a bill of exchange. Where he says, I undertake to pay. So now the bank has said, I am willing to avalize. Now expert is asking, now we go back. Importer goes back and says, importer bank says, look here, exporter, we told Mr. Banda to come and take the documents, and we told him that we will avalize to come and sign the bill of exchange. He says, I don't want the goods. So we are sorry. Then exporter will say, no, you said you'll avalize. Then the importer bank will say, yes, we told we will avalize. What did we say? What do you mean by avalize? Avalize means if the importer comes, takes the bill of exchange, accepts the goods, and then if he gives an undertaking to pay on November 12th and signs the bill of exchange, and if on that date he doesn't make the payment, then we as the avalizing bank will pay you. So we are only, avalize means the bank is guaranteeing the guarantee of payment by the importer. It's not guarantee payment. It is guaranteeing the guarantee or undertaking given by the importer. Now, if the importer has not given an undertaking to pay, the importer has not signed a bill of exchange, right? What is the evaluation the bank can do? Bank has to guarantee the undertaking by the importer. Importer has not signed any undertaking. So if the importer has not signed any undertaking, how can the importer's bank avalize? Avalize means importer's bank is going to guarantee the undertaking given by the importer. So if the importer is not giving an undertaking, then there's nothing for the bank to avalize. Now this is the point. Even if it is avalized, even if the bank is willing to, importer willing to avalize, it all depends on the importer. If the importer in a document against payment, it depends on the importer whether he wants to pay and take it. If it is on a DA basis, it all depends whether the importer wants to sign the bill of exchange and give an undertaking that he will pay. Or if it is on DA avalize, only if the importer undertakes, signs the bill and undertakes to pay, and he fails to pay, then only the bank can guarantee. But if he doesn't sign any undertaking, the bank can't avalize, right? So even under avalization or documents against payment, the risk of exporter not getting the money is there, right? So there I will stop. Now on documented credits, we are trying to show you how that risk is overcome. Okay guys, shall we stop for today? I hope. So now you know now, collection, the risk is whether it's DA, DP or de-avalize, nothing can be done if the importer is not willing to pay money and take the document, or take it on DA terms, or accept and make the bank guarantee the payment. So if he doesn't accept documents, even the bank can't avalize. That is the risk that the exporter takes on the collection. So he's not sure of the payment. When you go document credits, you will see how that risk is overcome. Okay guys, I'm going to stop for today and we will continue next week.